As Fed officials downplay a 50 basis point hike in March. Upbeat earnings, Alphabet bounces as the tech giant beats on sales and profit. The company also announces a 20-for-1 stock split. Plus, Santander pledges to raise profitability growth after beating on earnings. We will speak to Executive Chairman Anna Boden this hour.
Interesting earnings day. It's interesting to see actually a lot of them beating expectations. Yesterday we had that figure, Tom, 80% either in line or beating. Yep. And what was also interesting is that out of these 6 Fed speakers, actually they're a lot less bullish than the markets are. And so I wonder whether we need to look at the money markets to see whether they're repricing some of the hikes. Yeah, currently the money market's pricing in about 29 basis points in terms of the hikes in March. But you're absolutely right. No officials, none of these Fed officials, none of the 6 who came out and have been speaking over the last few days have said that they expect to see 50 basis points in March. So softening the edges of that more hawkish bent then that the markets had taken from Jay Powell's commentary when he was pressed on this during his press conference. So 2 factors really shoring up the markets at that moment. It seems, the speak from those Fed officials, but also the earnings picture, that strength that we're getting through from the likes of Alphabet, which arguably is a very good litmus test of the broader economic health of the United States, given that exposure to advertising. In terms of how the markets are opening across the European space, up 0.5% for your FTSE 100, 37 points. The Spanish IBEX is gaining 0.4%, up 33 points, and the CAC 40 is gaining 0.3%. We're talking about Santander. We're going to be speaking to the chairman, as we say, just in the next few minutes or so, but gains across the Spanish IBEX, again, 0.4% on the back of Santander. That will be a beat that's playing in to what you're seeing in the Spanish IBEX. Let's see how things are playing out cross-asset then as we look to the futures after a third day of solid gains stateside, as we said in those headlines. The futures pointing to further gains of 0.5% at least for now in the US. The Bloomberg Dollar Index is a little softer by 0.1%. Certainly you saw a bit of pressure on the greenback yesterday, supportive, of course, for EM and other parts of these equity asset markets. The US 10-year is at 178, so you're seeing yields up just a little bit, but still below that 180 level. Brent is in focus because it's OPEC Plus today, $89 a barrel, gains of 0.1%, but the bigger picture is that even they make these pledges to increase output, can they actually match it? So far, the data that Bloomberg's been looking at suggests that they cannot. They are failing to do that. Just 50,000 barrels per day added because they're facing constraints from the likes of Libya, etc. So how that plays into the broader price picture for oil and inflation, of course, is crucial, Fran. Yeah, so one of my morning must-reads, Tom, of course, is Van Ram, looking at what Warren Buffett's old adage for making money is, and you get burned once, but you learn. So there's nothing like focusing the mind when you actually start losing a little bit of money, and this is the kind of markets that we could see going forward. Tech leading the gains after we had AMD, and of course Google. Today the big one is Meta, formerly known as Facebook. Industrial materials, the second biggest gainers, gaining some 0.7% overall, and actually healthcare weakest, but it's still gaining in touch. Healthcare, if you look at healthcare, mixed picture because of some of the vaccines approval, so you have some of the stocks down, but overall the sector still gaining a touch.
Okay, in terms of the corporate news, we have, of course, Santander, as I say. Stay tuned for that important interview. Down 0.3% as things stand. And as we were saying, the earnings came in above estimates. Promise as well, a pledge there by Santander to improve profitability. Return on equity, the target is above 13%. Currently down 0.3%. Vodafone was also a beat. Up more than 2.6%. That's a boost, really, for the CEO, who's facing, of course, that activist investor. So that challenge there, but the CEO getting a lift from a solid set of earnings from Vodafone. TeamViewer, this is a German-based software company. Look at that, gains of 12%. Their earnings met, but they also announced a share buyback as well. That's propelling those shares for TeamViewer higher. A couple of corporate stories we have our eyes on. Fran.
Yeah, I like TeamViewer. I actually had to Google exactly what it was, but not a good return if you actually invest in the last couple of months. Now, in just a few minutes, we'll be speaking to the Santander Executive Chair, Ana Botín. We'll ask her about capital, about some of the earnings that actually beat expectations. We'll also ask her about inflation, especially in Spain. That conversation coming up. Don't miss it. This is Bloomberg. Then, coming up a little bit later, we also, Tom, look at some of the other earnings. I'm really interested in what Facebook, now known as Meta, still confusing for a lot of investors, will come out with, and whether they also benefit from that extra advertising spending like we saw with some of the other companies that reported yesterday, Alphabet.
Yeah, absolutely. You've got the idiosyncrasies of PayPal. That fell on the back of some of the challenges they face around eBay and the exposure they have to that business. I think that's less interesting than Alphabet, given the size and scope of this business. And as you say, the ad sales growth that they're seeing there. And of course, they had the stock split. But the ad sales, again, points to that strength across the broader economy. Meta is likely to pick up from that. Starbucks, by the way, that was interesting in terms of inflation and wage growth. They're now paying $17 on average, Starbucks, to their employees stateside to retain that talent. Frank.
Yeah, I'm so glad you didn't say that I would have to spend $17 on my cappuccino, though we may not be far off, given the price of Arabica coffee. Now let's get straight to the Bloomberg Business Flash. Here's Laura Wright. Hi, Laura.
Hi, Francine. Alphabet shares have jumped, as Tom was saying, on earnings that topped estimates and a 24-1 stock split. Fourth quarter sales, excluding partner payouts, rose 33% to almost $62 billion. Gains were, of course, driven by advertising and the focus on e-commerce. Cloud revenue only narrowly beat the street, and another sign the division's growth won't overtake Amazon or Microsoft anytime soon. AMD stock rallied as much as 12% in late trading after giving a surprisingly strong sales forecast, suggesting it's making further gains on rival Intel. The chipmaker's first quarter sales outlook outpaced Wall Street estimates as it reached a level of profitability that's nearly identical to Intel's, something that would have been inconceivable just a few years ago. PayPal plunged in late trade after growth in spending on its platform continued to slow during the fourth quarter as economies reopen and consumers return to in-store shopping. Total payments volume climbed 23% to just under $340 billion in the final 3 months of 2021. That was the smallest increase in 2 years. ExxonMobil is trying to accelerate the pace of a $10 billion share buyback after posting the biggest profit in almost 8 years amid a broad rally in energy prices. Aggressive spending cuts helped the oil giant capitalize on surging energy demand. One measure of cash flow more than tripled to almost $18 billion during the final 3 months of 2021 compared with a year earlier. That's the Bloomberg Business Flash. Tom, Francine.
Laura Wright, thank you very much. Okay, let's get into the key market drivers with our markets editor, Christine Aquino. Christine, we talk about the earnings. We want to unpack that, certainly. I think that is arguably the most interesting point. But also the Fed officials coming back. Are they walking back the commentary from Jay Powell, who struck, for the markets at least, struck a hawkish tone in that press conference? Is this a coordinated approach, an attempt by Fed officials to kind of soften the edges here?
Well, it certainly seems that way, Tom. And I think it's really adding nuance to what the Fed is planning to do this year, more than any sort of walk back from the message that we heard from Jay Powell last week, where we're seeing, I think the Fed is still very much raring to go in terms of its rate hiking cycle this year, but they're also wanting to indicate to the markets that, you know, they're not going to do anything crazy like a 50 basis point rate hike, for instance, in March. Some commentators were perhaps expecting or potentially putting a damper on some of those expectations for perhaps 6 or 7 rate hikes this year. So I think what we're really seeing here is kind of adding more nuance to that message of still an overall hawkish Fed, but just a bit more measured in the way they approach that.
Yeah, a little bit more measured and nuance. Always a beautiful thing. I feel it's also the modus operandi of the markets in 2022. Now, you were also saying that PayPal and Google really shows the asymmetric risk when it comes to beating or actually disappointing in earnings.
Absolutely, Francine. I think as our Bloomberg opinion colleague John Authors points out, there really is now kind of a baseline expectation for surprises in earnings, which is kind of ironic, but I think that really is what markets want to see now, is that these companies, particularly those in the tech sector, consistently beating expectations. And if they don't, as we saw with PayPal, they really are being punished perhaps a lot more than companies who are beating estimates are being rewarded. market. I think it really is just an expectations game, especially when companies have come out really roaring after those really low expectations from the pandemic era, coming back from that, and now the game is really beating those estimates. And if you don't, then you'll really get punished by investors here, as what we're seeing.
The ability for companies to hold on to pricing power and margins has been a key for most of the analysts and the strategists we get on the show. How are things shaping up across the European equity space? Which companies, which sectors are holding up best when it comes to that ability to maintain margins?
Well, Tom, I think what we've really seen in Europe is some of those more luxury type companies, right? We're talking about the LVMHs really wielding that pricing power. And it's understandable because luxury goods tend to be Veblen goods. The higher the price, the more desirable they seem. But for other sectors, such as those in the materials and financial sectors, those who are really exposed to some of these issues of higher costs and supply chain issues, it's a different story for them, I think. It's really, we're seeing some of that margin pressure really coming through, and EPS estimates coming down for 2022 as well. And so I think for Europe earnings, investors are really looking for companies to wield that pricing power, as you say, Tom. And if there's evidence of them not doing that, then it's not really great news.
Christine, I have a funny but not funny MMR, but I really liked it. I always read Van Ram when I come in the morning, and this is how he puts it. Now, he reminded us some of the things that Warren Buffett likes to say, which is there's nothing that dulls the brain than a few instances of making money. Last years of unchecked money creation and central bank bond purchases overstayed their best by date, have contributed to investors treating the smart stock market like a casino. And this is probably the overarching theme of 2022. It's going to be harder, so you have to earn your money as a trader.
Absolutely, Francine. I think the casino analogy is really great because if 2021 was investors playing in a casino, 2022 is when all the lights come on and they realize that they've lost too much money on the table and they're going to have to start reeling it in. So that's definitely the mood coming into this year for sure.
Yeah, research papers flying left, right, and center. Christina Aquino there with your market view. Now, coming up, Spanish banking giant Santander pledges to raise profitability as it reports fourth quarter net income beating estimates. We speak to the executive chair, Anna Botín. That's coming up next, and this is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
Welcome back to the Open. We are 13 minutes into your European trading day. The stocks across the European stock 600 gaining 0.5%. Just one of the major indexes in the red currently, just by a smidge, is the Spanish IBEX. Across your sectors, top of the list is technology gaining more than 1%. Two sectors in the red this morning, energy and banks. But technology, of course, getting a boost from what happened in terms of the results from Alphabet and AMD, the chip maker, as well. Fran.
Now, Santander has pledged to raise profitability as it benefits from revenue tailwinds with interest rates on the way up in key markets. While Spain's biggest bank plans to increase its underlying return on tangible equity, a key profitability metric, above 13% this year. Well, I'm very pleased to be joined now by the chair of Santander. She's Anna Botín. Anna, thank you, as always, for giving us a little bit of your time. Talk to us, first of all, how Santander will benefit concretely as the interest rates rise across the world.
Sure, Francine, good to be with you. So as you said, I mean, 2021 has been an excellent year. We're on track to meet our 2019 targets in spite of the pandemic, with profitability near 13%. Very importantly, it's been a pivotal year for us in capital as we reached the 12% fully loaded, that we're actually targeting 11 to 12. So we, all in all, have delivered excellent performance across all our regions. North America and Europe doubling profits from last year, Brazil and Chile being the best bank in the markets in profitability, and interest rates actually would help us. So we are positioned for higher rates. We believe that's going to happen across all our markets sooner or later, depending on where. And so we're very excited about the future because we're also investing for the future, delivering today, but also getting ready for what is coming over the next few years.
Anna Botín, today, what's your message actually on capital to investors? I know in the past you've said that there has been a lot of pressure from investors, but that the risks are just not the same for Santander because you're a retail bank compared to some of the large investment banks.
So that's precisely the point. You know, our scale and diversification are competitive strengths that continue to make us different. So revenues were strong across all region segments and businesses. We had a standout performance in the US with 24% return on tangible equity. A few years ago, it was other regions that were doing better. And that's the reason why 12% fully loaded for us is not just enough for us to continue growing. It's enough to increase returns to shareholders. And it's enough to have a very strong, rock-solid balance sheet. And that is really important. So we announced this year, and that's a first for Santander, buyback of our shares. If you consider buybacks and dividend, we're around 6% yield, and we believe investing in our own shares, again, it's a first for us, it's an excellent investment of our capital.
So what are your plans for the U.S. consumer, now that you've bought back some, bought out minorities?
So U.S. has done incredibly well over the last few years. We're coming from 350 million profit in 17 to in euros 2.3, 2.4 this year. It's an excellent business. Importantly, we announced the closing of a minority buyback on this Monday, and this will allow us to pivot our business to being a consumer finance business. It's a business where we are leaders in Europe, in Latin America. We have a very strong position in the US. Combining that with the core deposits in our retail bank, we are targeting 19% returns for next year, and through the cycle, 15%, which is an excellent return in the US. Very importantly, it has very strong connectivity to our other regions and businesses. Again, we're the leading auto finance bank probably in the world, and this is a business where we believe we can generate lots of value for shareholders by having a presence in the US.
Anna Botín, talk to me a little bit about some of these inflationary pressures that we saw, especially in Spain, and also GDP growth was not as strong as expected in Spain. Is there a worry that Europe goes into stagflation, and what does it mean for your cost pressures and also having to increase people's wages?
So in terms of cost pressure, I think that's where we are undisputably one of the leaders. Our cost income at 46, targeting 45%. But very importantly, the way we're doing our changes in our business model is going to allow us to be much more efficient, but also to allow us to grow, right? So inflation is net, if it's not too much, it's actually a good thing. I mean, having negative rates is not ideal, not just for us, but for the economy in general. So progressively, as we're doing, going to a bit higher rates is actually good as long as we don't do it too fast, of course. We're positioned for higher rates. And the key here, there's a few things, right? The supply chain knots need to be resolved. Consumer spending that has been channeled into goods should be now going to services. This is great for Spain, by the way, because 13% of our economy is in tourism. The key here, of course, at the end for me is wage pressure and to some extent, of course, energy prices also. So if we can manage those items, I know there's quite a few there, I think inflation, ECB is still targeting 2% for 23, which means that the pressure in the, at least in Europe, is going to be less than in the US or the Americas.
But so are you looking at increasing wages?
In some markets, for sure, but we're more, we've committed to another billion for 21, 22 of cost cutting, of reduced cost, again, by changing the business model. But at the end, what matters, Francine, is that we're increasing revenues more than cost, what you call operating leverage. It's a positive operating leverage. That's the key to any business. Growing revenues at 7 and cost at 3 is okay. The opposite, of course, would not be good. And that is exactly what we've done this year in 21, and we aim to do again in 22. Grow revenues, grow customers. We grew 5 million customers to 153 million total. And growing revenues, being very careful about cost. In Europe, we will reduce cost again, by changing the business model and building platforms together.
Anna, talk to me about how you'll deploy capital. So there's a rumor that Santander is looking at Citigroup's retail banking operations in Mexico. Can you confirm that?
So our business in Mexico is excellent. We are increasing profitability. We've built from zero a consumer finance business, much as the one we have in the US and Europe, from scratch to 10% market share. We are again, growing in customers. Having said that, and we've said it in the past, it's one of our core markets. So when the process begins, we expect to be part of that process.
So meaning that is there a treasure trove where you would actually be happy to quite spend on that? And where else do you want to grow non-organically through acquisitions?
Our strategy is to grow organically. Again, we have 153 million customers, lots of space to grow, 5 million customers in a year. We're targeting higher growth. As an example, in Europe, which is not a high growth market, we added just 2 million customers in our digital consumer bank. We built a buy now, pay later, which is now, the way consumers want to finance their purchases within 6 months. It has added 2 million customers organically. So again, we can grow organically. Not many banks can say that. That's our preference. But as we've done in the past, we will be part of processes in our core markets. It would not always, translate into actually doing a deal. You can look back and see that we participated in some and didn't do anything, and in others we did.
Right.
We'll be very, that's exactly what we'll do in this case.
Anna, what do you think will happen in the lawsuit with Andrea Urchel?
That's a matter for the courts to decide. Again, we've been successful in a couple of his, processes, and this one is still under judicial review, so we should not comment on that. We're focused on the business.
Do you think his compensation package will have to be reduced? Or can you tell us anything on how you see this playing out and whether shareholders are asking about it?
They're not really asking about it. That's a matter for the courts to decide. We've said we disagree with the ruling. It's going to the higher court, and we're appealing.
All right. Thank you so much for joining us. Anna Butin there, the Santander chair, and we'll have, of course, plenty more on some of the earnings coming up with Santander actually beating on the earnings front and also announcing a pretty aggressive CET1 strategy, Tom.
Yeah, that profitability target in terms of return on equity. Great interview. Thank you, Francine. Coming up, we're going to look at what's moving markets this morning, including German work from home darling TeamViewer. They are up significantly this morning. We're going to have that chat with our Danny Berger next. This is Bloomberg.
Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
From New York City.
Here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
The company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
Welcome back to the European Open. Let's focus in now on some of the stocks on the move this morning. Join us now is Bloomberg's Day Break Europe anchor Danny Berger. Danny, what are you looking at?
Well, it is a very busy earnings day. I feel like every single company in the world is reporting today. So
today.
Yeah, exactly. Today is the day. So let's kick it off with Vodafone. Shares up 2.4%. This will be Vodafone's highest since May. They beat on their organic revenue, coming in at 2.87%. Rather, estimate was for 2.2. But this is important for Vodafone because at the moment they're trying to deal with activist investors. A great Bloomberg scoop from last week that Cevian has taken a stake in Vodafone. So Vodafone, this gives the CEO a little bit of breathing room as it bats that off. Also, a big day for tech. We had those great tech earnings on Wall Street yesterday. Today, we have TeamViewer, of course, the work from home stock listed in Germany, up 15.6%. Earnings were in line. Their 2022 outlook, they're maintaining. The important thing here, though, is a lot of buybacks, about 10% of shares outstanding. And finally, Julius Baer. Results were strong, but it's the biggest loser on the stock 600. What's plaguing them, Tom and Fran, is the issue that's plaguing all of Wall Street. It's costs. Costs came in higher than expected.
Yeah, we just had a conversation also with Santander. Costs also at the forefront of their worries. And I like the way that Christina Kino put it. Look, it's an asymmetric race, so you do well and actually your shares fly off the shelves, and you do badly and actually really get punished.
You really get punished, yeah, we felt that.
Shares in Google parent Alphabet soaring in after-hours trading as the company posted results that beat estimates. So we'll talk tech next. This is Bloomberg.
nuestro estudio, nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Upbeat earnings. Alphabet bounces as the tech giant beats on sales and profit. The company also announces a 20-for-1 stock split. Talking down the Hawks, U.S. stocks post their best three-day rally since 2020 as Fed officials downplay a 50 basis point hike in March. Plus the crude question, OPEC Plus looks to ratify another production increase today, but they barely managed to raise output last month amid surging oil prices. Well, Tom, there's quite a lot going on in the markets, actually. There's a move on the 2-year in Germany. We weighed the ECB and the Bank of England. And then this, we've had 6 Fed speakers. James Bullard, probably the most hawkish. And he is saying, look, I wouldn't go too much on we're going to hike rates a lot this year. Yeah, so there's 6 officials coming out. Unlikely you're going to get 50 basis points in March. Of course, the central bank's still very much in focus, as Fran is saying, with ECB, the BOE tomorrow, but also a focus on the fundamentals with these earnings coming in thick and fast. The gains across the European index, 0.6%. The backdrop, by the way, for the US markets is that for the month of January, you got that peak to trough. We're above that peak to trough, the midway point now. And some are suggesting the midway point that we saw in January, I should say, back to that level that we saw. The midway point, the peak to trough from January, we're back above that midway level. That points for some to further upside. That can be sustained. That's the argument for some looking at. In terms of the markets here, gains of 0.6%. For DAX and Germany, gains of 0.4%. A similar picture over in France, the CAC 40 in a similar territory, and the FTSE 100 as well, gaining 36 points. So some optimism, muted optimism, you would suggest as we look up to the ECB and the BOE tomorrow. But again, it's all about addressing the earnings as well within the context of the shift around monetary policy. Chemicals at the top of the list, gaining more than 1%, followed by financial services, media, technology, of course, on the back of those Alphabet earnings. AMD, the chip maker as well, coming in with some optimism. A little bit of pressure on the likes of Starbucks and PayPal, their earnings not quite meeting expectations. In terms of energy, that is the one sector that is losing currently, down 0.5%. Interesting to see that gas prices dropped yesterday across the European space. More inflows from Russia amidst these continuing geopolitical tensions. Fran? Yeah, shares in Google, parent Alphabet, have soared in after-hours trading, Tom. That's after the company posted fourth-quarter sales and profit that topped projections, showing the resilience of its advertising business in the face of a major economic upheaval. Now, for that, and a look at other tech earnings, joining us is Marcus Morris-Aiton, portfolio manager at Allianz Global Investors, and here in the studio is Alex Webb from Bloomberg. Quick take. Alex, first of all, well, good morning to you, Marcus, as well. But Alex, if you do good, your share price does maybe better than expected. But if you do bad, investors really punish you.
Yeah, there's a real skittishness as far as the big tech stocks are concerned at the moment. They are trading at obviously a premium to the rest of the market. Interestingly, though, Google not at as significant a premium as the likes of Apple, Microsoft, and Amazon, which means that they didn't need to do as well to be rewarded in the share price. Nonetheless, the advertising business jumped 33%, as did revenue as a whole. In the Christmas season, coming out of COVID, it was clearly good news, and they've been rewarded accordingly.
And Alex, the stock split, Alphabet for the masses, is how some people are looking at this. How does it compare to what other companies have done when it comes to dividing up the shares?
Well, Apple made a similar move recently. It gave 4 shares for each one that you already held. Google's delivering 20 shares apiece to its shareholders, so a $2,700 stock will become feasibly something like a $13, $14 stock. So it perhaps makes it a little more accessible to retail investors if they can get over the fact that when they search for Google, they will find Alphabet.
So let's also bring in Marcus Morris-Aiton. Marcus, how do you look at technology, and actually what's the place in technology that you want to be invested in right now?
I think technology is one of our favourite areas of the market at the moment. The sector in Europe is at least derated by 10% year to date. And as you've just been discussing, that's broadly off the back of fairly healthy earnings. So in Europe, we've seen a fairly severe value rotation. And myself as a growth investor, they're certainly painful in the short term, but they actually throw up many of the more interesting opportunities for the long term. So what we're trying to do is identify areas, and many of those appear to be in the tech sector, where you've seen a clear decoupling away from fundamentals off the back of the news out of the Fed.
What would you need to see to get you back into some more of the speculative, more of the frothy parts of the tech sector? Would you avoid that for good now? I mean, I'm thinking, you know, ARK, ETF, Cathy Wood. What would you need to see to make that attractive once again?
I think the issue there is the sustainability of earnings, and that's really been the eye of the storm. And that's exactly where we don't play. I mean, those are very strong momentum plays, but actually when the macro picture becomes more convoluted, they are the most exposed. So we would much rather focus on companies that have clear, sustainable earnings growth over a multi-year period and reasonable cash generation. And so that typically leads you away from areas like that ARK ETF.
So where do you stand, Marcus, on value versus growth right now? And could that change by the end of the year?
Well, I hold my hands up here. We are growth investors, so I would always be in the growth camp. But genuinely, I think we feel much more confident on where we stand in the rotation than we did a month or so ago. That rotation is one of the most extreme we've seen, both in terms of the duration, but also the magnitude of that. And it was actually a bit more nuanced than many people believed. On the one hand, you had the initial sort of cyclical value rally as the data from Omicron was less bad than people believed. And then secondly, we had very much a risk-off defensive value rally driven by the Fed and the geopolitical issues in Russia. What's clear, though, is the air gets tighter from here. The market is now pricing in 5 Fed rate hikes this year, and you can debate whether that's a 50 basis point increase in March or not. But it's important to remember the picture is very different in Europe. In Europe, we're rather talking about 2.5 rate hikes. And what I think is important is as we move into the core of earnings season, it's actually the earnings themselves that are beginning to drive shares. And that's a much better position for long-term investors, regardless of whether you're value or growth.
Alex, let's bring you back in here at this point before we let you go. As we look ahead to Meta and some of the other big tech names, where is your focus?
Look, Facebook is very similar to what Google does. They are basically advertising technology companies. It'll be interesting to see the extent to which they've been impacted by a crackdown at Apple on the ability to take data from other apps. Amazon, a bit of read across from Google, because if people are advertising, then you'd assume people are also buying.
Marcus, very quickly, the big tech, are they value or are they growth stocks?
That's a very good question. I think there's a combination of both there. And actually some of the US FANGs are not particularly expensive. And I think the European tech sector is widely misunderstood. So generally the tech sector is growth, but there are definitely value opportunities in that space.
Okay, the European tech sector is wildly misunderstood. That debate is a good one to have, Francine.
An Alex Webb question. He said, we need to understand whether it's growth or value.
Thank you, Alex, as ever, for feeding us the best questions. Okay, that's Bloomberg Quick Takes, Alex Webb. Marcus Morris-Ayton from Allianz Global Investors stays with us. Get more of his calls after the break. Coming up, the latest on the pandemic parties as Boris Johnson promises to publish the full report into government parties. That story is next. This is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And, you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project, initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
Welcome back to the Open, everyone. 40 minutes into the European trading day, and you can see liftoff for a lot of these stocks, gaining 0.5%. The DAX, the CAC, gaining 0.3%. But certainly there was a recovery in U.S. stocks yesterday, and that was spurred by the fact that we heard many Fed speakers saying that they will be quite gradual and measured in their approach to interest rate hikes. Also, oil steady near a 7-year high ahead of that OPEC Plus meeting that could give us an indication also of how inflation plays out in Europe and the U.S.
Yeah, back to UK politics now. Boris Johnson's latest effort to get the British public's attention back onto his policy plans is at risk of being drowned out by yet more reports of lockdown gatherings at 10 Downing Street. The Guardian reports today that the Prime Minister attended another leaving party for staff in January of 2021. I've lost count now. Johnson has pledged to publish the full civil service investigation into the scandal. Joining us now to discuss the UK political landscape is Bloomberg opinion editor and columnist Therese Raphael. Therese, do these promises convince you? Do they convince anyone that we'll actually see the full unredacted report?
I think we'll believe it when we see it, but what's clear is there's a lot of pressure on Boris Johnson, not just from the opposition now, but really from his own backbenches to publish the full report, to disclose any penalty notice, any fines that are given by the police. But right now, you know, this is all about, for Boris Johnson, playing for time, trying to change the subject, and trying to convince MPs that whatever damage has been done is outweighed by his potential to win a future election.
Yeah, and Therese, does it really matter if we have the full report? I mean, we all get the picture of what was happening at Downing Street. We had another now Tory MP calling for his resignation, but until we have the numbers, is he just going to stay put?
Yeah, I mean, that's an interesting thing. The Sue Gray report, which was, as you know, an update of only a few pages long in the end, had some very damning lines in it. It said that there had been a serious failure. Effectively, she gave a verdict on, what everyone, in Whitehall speak are gatherings, for the rest of the world are just simply parties. And, she said that these were, effectively rule breaking, not exactly in that language. So, yeah, I think you're right. From much of the British public, their mind is made up. There was, a clear breach of the rules that Boris Johnson himself made. But the decision-making body here at the moment is Tory MPs. And I think that's, his job right now is to convince backbench MPs to stick with him. Now, we don't know when this police report investigation is going to come out. We do know the police have some 300 photographs, some 500 pages of evidence. I'd be very surprised if some of those photographs don't come out at some point. And, a photo circulating around the internet can also do a lot of damage. So, I mean, I think one question for me is whether we get the police investigation results before the May election or after the May election, because that will determine when the real crunch point is for Boris Johnson.
Okay, Therese Raphael, as ever, Bloomberg opinion columnist on the political perils still facing Boris Johnson. Marcus Morris-Ayton, portfolio manager at Allianz Global Investors, is still with us. Marcus, the markets here in the UK have largely looked through the political angst facing Bojo and team. Is this because the value proposition, the relative value proposition of UK equities is just that much more compelling in the environment that we're in now?
Yeah, I think you're absolutely right there. I mean, life doesn't get any easier for Boris Johnson day by day. But fortunately for the UK stock market, it's the first time in many years now that it's actually leading world indices. And I think that's largely due to the composition of the index. On the one hand, there's the valuation argument, and the FTSE is trading on literally less than half of the valuation of the US market. But secondly, the UK index is very much geared towards commodity plays and the typical value sectors that benefit from a rising rate environment.
But Marcus, the relative valuation, and we have a great chart we need to applaud our queen of charts, Valerie. When you look at the relative valuation, it's for a reason. So why do you think they could outperform this year?
The valuation gap is certainly for a reason, and that's largely explained by the difference in sector composition between the UK market, for example, where you have very little tech exposure, and you have a lot of exposure to many of the more legacy sectors like energy, like banking and mining, etc. But these are sectors that tend to do well when rates are rising. And on the flip side of that, the US market is certainly overweight long duration assets that do struggle more in that rising rate environment. So I think if you're bullish on rates, the UK market is probably a good place to be.
Okay, Marcus, another hat tip here to our charts team led by Valerie, because I want to talk about what's happening in terms of, we get so many guests on who say, look, you've got to look at the fundamentals, you've got to look at the strength of the balance sheet in this environment. Corporate balance sheets are so crucial. And yet, it is companies with the weaker balance sheets that outperformed those with stronger balance sheets. What does that dynamic tell you? Does that party come to an end?
In all honesty, I don't think that shows you a lot. I mean, we're looking over a 1 month window there. If you stretch that chart back by 3 or 5 years, I suspect to see a very different picture. What that chart shows you is that we've seen a very strong value rally year to date in many of the typically weaker companies. And that was led at the beginning of the year, as said, because of the optimism surrounding Omicron. But I think on a 5-10 year view, you would typically be much better positioned than companies with healthy balance sheets that have the opportunities to deploy that cash they're generating.
But Marcus, are we in a post-pandemic environment, or are we still going to see support for some of the stocks that did well in the pandemic? We still don't know whether there's a new dangerous variant out there. I don't know how, as a portfolio manager, you actually decide that, not being a virologist.
Yeah, I think that's exactly the point. And I don't think I'd be brave enough to say we're post-pandemic, because we certainly live in a world where new mutations may occur at any time. That said, I think with the vaccine progress we've had, we have better mechanisms to control the spread of that. But I have no doubt that some of the changes we've seen in the business world, but also consumer life and social life, will stick post-COVID. So the challenge for us as investors is to try and understand which of those companies that have benefited during COVID, where that growth is sustainable and where that may fade back. But I certainly think there are a lot of companies that are in a far better position than they were 2 years ago. And actually post the rotation we've seen in the last month, they aren't trading at wildly different valuations to what they were 2 years ago.
Marcus, you flagged the fact that you think M&A is going to be a key theme as well into 2022, throughout 2022. Which sectors are most ripe, do you think, for mergers and acquisitions as a catalyst?
I think we'll see M&A in virtually all sectors. It's been one of my key predictions for the year. Over the last probably 12 months, you've seen many of the better capitalized companies really very willing to deploy their capital towards M&A targets, and are frustrated about their inability to because of the lack of travel due to COVID. As those travel restrictions ease and due diligence becomes easier, I think you'll see a lot of that capital deployed relatively quickly.
Marcus, thank you so much. Marcus Morris-Ayton there, portfolio manager at Allianz Global Investors. Coming up, oil steadies near a 7-year high as traders count down to today's OPEC Plus meeting. We'll have plenty more on that shortly. This is Bloomberg.
Airport, and behind me you can see SpiceJet 737 MAX aircraft. Said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
In crypto, you have a world of young people that want their own financial system and their own future. And it is very powerful, and I'm a big believer in it.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed. Welcome back to the Open. We are 51 minutes into your European trading day. Gains of 0.5% across the benchmark. Every sector bar two, energy and autos, are in the red. Everything else is in the green, led by financials. By the way, the Nasdaq futures pointing to further gains, more than 1%, building on what we saw yesterday. Of course, Alphabet coming out with some very decent earnings and doing the share split as well. We're looking ahead to the earnings from Meta plus others, of course, today. Let's get the Bloomberg Bloomberg First Word News with Laura Wright. Laura.
Thanks, Tom. Russian President Vladimir Putin has lambasted the US and its allies for deceiving Moscow over the expansion of NATO, but suggested further talks may still yield a resolution to its concerns. As tensions continue in the region, Putin met with Hungarian leader Viktor Orban, while UK Prime Minister Boris Johnson promised aid on a visit to Ukraine. COVID infections in New York State have fallen 92% from their peak a few weeks ago, with hospital admissions receding in 34 other states around the US. South Africa, meanwhile, the original epicenter of Omicron, has dropped the self-isolation requirement for those with no symptoms. In Europe, Norway is easing most of its COVID measures as it bets high vaccination rates will be enough to shield its health system. The UK government has published a long-awaited plan to reduce economic inequality, shifting some decision-making powers away from London and seeking to boost pay and productivity in poorer regions. Levelling up the country was a key catchphrase in the Conservative Party's election-winning campaign of 2019, as Boris Johnson's administration seeks to move the agenda on from the Partygate scandal. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg, Francine.
Laura, thanks so much. Laura Wright in London. Now, oil steady near a 7-year high ahead of today's OPEC Plus meeting. The plan is to ratify a modest output hike. The big question, of course, whether the alliance can actually deliver on its targets. Well, joining us now is our executive editor for energy and commodities, Will Kennedy. Will, the problem is compliance. When I covered OPEC a million years ago, it was all about compliance, and then we kind of talked a little bit less about compliance. But they're not even putting the barrels of oil on the market that they promised.
No, it's quite an unusual situation for seasoned OPEC observers, Francine, because normally the problem is people cheating and producing too much oil. Right now, OPEC isn't producing as much oil as it promised. It is meeting its targets by 122%, and many members are struggling to reach their targets. Russia, for example, the second most important member of the alliance together with Saudi Arabia, looks like it's going to miss its quota for 2 months in a row, albeit by about a modest 50,000 barrels a day. And that's really striking. Other members in Africa, for example, are way behind what they're planning to do. So the focus, as we have this very tight oil market and rising prices, is just whether OPEC can put the barrels into the market that the market needs.
Yeah, there's the Libya disruption that we've been talking about, Will, and then there is, of course, the lack of investment. So what is the time frame? How long do we have to look at the lack of increased output because of these challenges?
That's exactly right, Tom. What's happened here is that every OPEC member drastically reduced production during the initial COVID crisis, where we saw global demand plunge by perhaps a quarter and prices at one point fall below zero. And that means that they haven't been drilling like you would expect. and so production is failing to keep up. Now, the question is, how much can they start investing again, drilling more, doing that? With prices at $9, drilling makes sense and it's affordable. Sorry, at $90 a barrel, drilling makes sense, affordable. So it is reasonable to expect that some of this shortfall can be made up. But what's becoming increasingly clear is outside Saudi Arabia and to some extent the United Arab Emirates, OPEC does just not have an awful lot of spare capacity, and that's really going to come into focus as this market gets tighter.
So basically the burden, Will, is now on, you know, the Gulf nations, Saudi Arabia, UAE, Iraq, and Kuwait to put up extra barrels of oil. Can they do it?
Well, perhaps. I mean, at the moment, they're not going to deviate from their plan, is our understanding, to increase 400,000 barrels a day. Can those countries meet those targets? Yes, they can, with the possible exception of Kuwait, which has struggled a little bit. And clearly, Saudi Arabia retains a good whack of spare capacity. But the question is really going to start to be for the Saudis, what is the maximum you want to produce for a long period of time? And the world needs to ask itself, is it comfortable with running down Saudi spare capacity? Because really, that has historically been a shock absorber against unforeseen geopolitical events. And, you know, we wouldn't want to use that up too early, perhaps.
Okay, Bloomberg's Will Kennedy on the challenges for OPEC Plus ahead of that meeting. Of course, the attempts by the Biden administration to add additional barrels into these markets has done very little for these price pressures, Fran.
Yeah, investors actually overall just liking the earnings season. And we had concerns, or the markets had concerns, that the Fed would act too aggressively in hiking. That's kind of gone off the table. So global stocks heading for their biggest four-day rally, I think, since November 2020.
Yeah, the Nasdaq futures currently pointing to further gains of more than 1% across the benchmark. You're looking at gains of 0.4 here in Europe. That is it. Stay with us. This is Bloomberg.
Announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Difficult was it to go to investors and say, invest, give money, put money into a travel tech company within this environment?
It wasn't that difficult because TravelPerk is doing much, much better than the rest of the industry. In fact, we are at the moment growing at 4 times revenue of pre-COVID numbers.
Alongside other countries, we are also preparing a package of sanctions and other measures to be enacted.
I informed Mr. Prime Minister about it, that principal Russian concerns were ignored.
I would be supportive of a 25 basis point increase in March. Could we do 50? Yeah.
This is Bloomberg Surveillance, early edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Talking down the hawks while Fed officials downplay a 50 basis point hike in March. U.S. stocks post their best three-day rally since 2020. Santander pledges profitability growth this year. The Spanish bank hopes to benefit from rate hikes. In Brazil and the UK, we hear from our interview with Anna Butin this hour. And as easy as ABC, Alphabet beats on sales and profit. The tech giant also announces a 20-for-1 stock split. Now, to the markets, and actually we're now seeing a 4-day increase globally, the biggest increase that we've seen in the market since November 2020. Why? This is because we've had at least 6 Fed officials, including James Bullard, probably the most hawkish that we've heard from, and they've talked down a little bit of the market expectations. So this is where we are in terms of state of play. Wall Street expecting as many as 7 hikes from the Fed. Wall Street also expecting a 50 basis points hike in March, and actually a lot of Fed speakers saying, look, we're going to be much more cautious when it comes to monetary policy, and that is giving a bit of a support to stocks that are also benefiting from stocks and earnings that are actually beating expectations in the U.S. and Europe. Now, how it's all playing out, you can see the DAX, the CAC, and the FTSE gaining some 0.2%. There are specific earnings, and I really like the way our Christina Keener, our markets editor, put it. There's now an asymmetric risk. If you're an earnings call and actually you beat expectations, you can expect in a lot of cases your share price to rise by that, quite a lot. Case in point, Alphabet rising 9.2% pre-market. After earnings beat estimates. I think we have that stock for you. But if you disappoint, then be prepared also to be hit quite hard. You can see Alphabet, so the parent company of Google, gaining some 9%. We'll have a full roundup of some of the tech stocks, of course, what it means for where you want to be positioned. And the crazy great question from Alex Webb. If you look at some of these big high-tech valuations, are they a value stock or actually growth stock? I think that really goes to the heart of the matter for some portfolio managers. Now, Fed officials have a message for investors raising bets on rate hikes this year. Not so fast. Yes, this month, Jay Powell has declined to take a half-point move off the table or even outline the pace of further increases. The Philadelphia Fed President Patrick Harker also told Bloomberg that policymakers need to move now to control inflation.
We're going to stop the tapering in March. I would be supportive of a 25 basis point increase in March. Could we do 50? Yeah. Should we? Well, I'm a little less convinced of that right now, but we'll see how the data turn out in the next couple of weeks.
Well, with us to unpack today's key market drivers, our market editor, Christina Keener, and let's also welcome Nicola Mai, portfolio manager for sovereign credit at PIMCO. So thank you both for joining us. A million questions on what we heard, Christine, from the Fed. It was interesting that a lot of Fed speakers are actually tempering some of the expectations that we see on Wall Street, but Jay Powell didn't actually really take them off the table. Are they hoping that they'll be seen as more dovish than the markets are pricing in?
Well, Francine, I think the hope from the Fed is certainly at least a little bit more measured in their hawkish stance overall. I think that's really what the communication effort that we've seen this week from various Fed officials, still reinforcing the hawkish message for sure from Jay Powell, especially from last week, but certainly reining in some of those expectations from Wall Street that have potentially gotten a little bit out of hand. We're talking 7 rate hikes this year, as you mentioned earlier. Perhaps that's a little bit much, and that's kind of what we're hearing as an indication from these officials.
Yeah, Nicola, the problem is that March, in market terms, is a really long time away. So what are you expecting, for March, and how many hikes this year?
Right, I think March, a 25 basis point hike is almost certain. I think 50 basis points, while not completely impossible to rule out, is very unlikely. I think, the Fed hasn't done 50 basis points in over 20 years, and I think the impact of markets would be uncertain. And for this year as a whole, we expect around 4 hikes, so once a quarter. It's possible that the Fed will accelerate the pace. I mean, I think in the near term, in that, I think the Fed is very data dependent right now. It's not a Fed that is keen to suppress volatility in the same way as before because of its inflation concerns. So in the near term, there is a risk of a quicker pace of tightening
So Nicola, what's the right way to do this? You know, if you look at sequencing, is it right that the Fed is a little bit more aggressive maybe in March so that they see how inflation pans out in the summer? And what does it mean for where you want to be on the curve? What are you buying?
Yeah, so while the uncertainty about the near term is significant, you know, I think our view remains that the terminal rate of the Fed remains low. So the view of the new neutral is unchanged. What we've been saying is that the terminal rate of the Fed will end at the level or below the level of the last cycle. So the last time they stopped at 2.3% or so, we think that's probably the maximum peak that we're going to see. So in terms of duration, treasuries, we want to be somewhat underweight right now, given strong growth and the beginning of the rate cycle. But I think the position is modest because we see rates as pretty anchored. So at the moment, the market is pricing a terminal rate of 175 or so. You know, we think it could be a little higher, but not much higher.
Yeah, and will this mainly play out, of course, I mean, it does play out in treasuries, Christine, 100%, but what does it do to dollar?
Well, Francine, I think that's a great question because we have seen that relationship between yields and the dollar really shift from what you would have expected in this sort of rate hiking cycle. And we really saw that kind of breaking down at the start of the year, perhaps because there's a little bit of risk aversion thrown in there as well that kind of complicates things for the dollar side of things. And so, yeah, I think it really is a function of the question of what this does in terms of the attraction of U.S. assets, because that's really when you can kind of get a gauge for how attractive the dollar would be and how attractive treasuries would be. I think this week we're seeing a situation where treasury yields are actually pulling back from some of those multi-month, multi-year highs that we saw last week, and the dollar going down with them. So as for this week alone, anyway, the relationship seems to be back in order, and both are heading lower.
Nicola, why are we not talking more about the fact that actually through the last quarter of 2021, the major central banks around the world kept on telling us, look, inflation is transitory, inflation is transitory. The market did not believe them, and the market was right.
Well, I think the market is, I think it's to be seen in the sense that transitory by now is a bit of an outdated word in that inflation has been higher and more persistent than expected. But in our mind, inflation is likely to peak in the near term. I think it's already peaked in the Eurozone. We'll see the report at 10 a.m. We think it's going to peak in Q1 in the US and in Q2 in the UK. And I think the market ultimately also buys into that, because if you look at long-term inflation break-evens, they're actually very anchored. And I think the expectation by both the market and central banks remains that inflation is going to come down, albeit from a higher level than expected before.
All right, we have some great charts coming up. We look at the BOE and we also look at German two-year yields. Our markets editor there, Christine Aquino and Nicola Mai from PIMCO, both stay with us. Now, we'll have plenty more, of course, on corporate news as well. Alphabet rising some 9.2% pre-market. This is after announcing earnings that beat expectations, and also the news on the stock split, 10% in pre-market. It'd be really interesting to see whether that also gives a lift to the broader tech market. PayPal in U.S. market, and this is exactly what our markets editor was saying. There's an asymmetric risk in the markets, especially when it comes to earnings. You disappoint, you get punished for it. You do better than expected, and really the share price can fly off the shelf. PayPal down 16%, also pre-market. Coming up, the ECB and Bank of England are getting set for policy announcements tomorrow. We'll preview the meetings next. This is Bloomberg.
Variant and the latest wave have an impact on not only consumer trends but your business, and do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacquet here in London. Now, a big day for central banks tomorrow, with both the ECB and the Bank of England due to make rate decisions. Meanwhile, we're waiting for the release of Eurozone inflation data due in less than an hour. Now, consumer prices estimated to have risen 4.4% in the year to January, slowing from December's reading. Well, we're joined by our markets editor, Christine Aquino, and Nicola Mai from PIMCO. Christine, without a doubt, the Bank of England, probably one of the most interesting central banks, not only because of that miscommunication mishap last year, but they were the first one to hike in this kind of cycle. So what are you expecting to hear from them tomorrow?
Well, Francine, I'd be very keen to see how they're going to manage this simultaneous rate hiking cycle and their balance sheet roll-off. Remember that the Bank of England has alluded to certain thresholds when it comes to its interest rates that would pave the way for them to start that process of rolling off their balance sheet. For instance, when they get to 0.5%, which is expected tomorrow, that's when they start kind of stopping the reinvestment of the assets on their balance sheet. And then when they get to 1%, which is expected in June, that's when they'll actually start to sell their gilt holdings. And so this is a very interesting experiment in playing with the levers of monetary policy tightening that central banks have. It certainly could be a good lesson for the Fed, because I'm sure they're going to be watching how they manage this and see if they can learn some lessons from that.
Yeah, certainly sequencing is a word that we pay a lot more. I feel like it's the word, it's the transitory of 2022. It's all about sequencing. Nicola, also the UK 2-year rates above 1% for the first time in a decade. That's the chart we just showed. Do you buy anything in gilts right now, Nicola?
Well, at the moment, I think gilts have priced in, a decent amount of tightening by the Bank of England. I think the terminal rate priced in the market is above 1.5%. I think at the moment there is some value in the short end of the UK curve, and that if we look at the last cycle, the peak policy rate in the UK was 0.75%. You could go a little higher this time, but not much higher in our view. So I think there's a little bit of value in the front end of the UK curve.
And Nicola, I have a great piece actually by our UK economist Dan Hansen, and he, points out to the fact that normally the difference in terms of inflation expectations using the forward curve for the whole forecast and keeping energies flat after 6 months isn't that large. It's not so the case. So could we look at the Bank of England hiking and then having to reverse that quite quickly, depending on what happens with energy prices towards the end of the year?
Yes, I think that's possible. I think maybe not reversing towards the end of the year, but reversing, at some point over the next 2 to 3 years, which is what the market is anticipating, is possible. I think, as I said, I think the peak inflation rate is likely to be hit around the middle of this year, and the concern about inflation expectations rising, about wage growth accelerating and so on, should dissipate as we go into the end of the year. So I think some kind of reversal over the next 2-3 years is something that is plausible.
I mean, I guess the MPC, let's remind all of our viewers that the MPC has a laser focus on headline inflation, but that could change.
Absolutely, Francine, yeah. And I think that is what makes their job tricky at the moment, is this very nature of inflation, whether it's transitory or not, is very much a real thing for consumers on the ground. But they as a central bank don't want to be conducting monetary policy in the short term. They want to be thinking about the long term as well. And so, as Nicola was pointing out, there's definitely expectations in the markets for that rate hiking cycle to peak around in 18 months from now, and then for the BOE to start considering paring some of those rate hikes that they are expected to deliver in that time.
I feel like we don't talk about the ECB enough because it's the more stable cousin of all the central banks. Nicola, what are you expecting from Christine Lagarde?
So, I think the ECB is in a different position from the Fed and the Bank of England for a few reasons. I mean, inflation is above target here as well. But let's remember that Europe has a history of inflation undershoots relative to the target. It has a less of a tight labor market. Wage growth, negotiated wage growth in the Eurozone is below 1.5%. And we've generally had less fiscal stimulus in the Eurozone, which means that the cycle is less advanced. So I think the ECB is obviously going to be vigilant on inflation going forward, but I think it's going to be more patient. And in that context, I think 25 basis points or so of rate hikes priced by.
Yeah. So, Nicola, I mean, we're looking basically at a policy shift that isn't quite tightening for the ECB, right? So they're still weaning the euro area off this ultra-loose monetary policy, Christine, but it's not quite the tightening that we're seeing elsewhere. So I guess that makes it for a possible differential play in the markets.
Absolutely, Francine, and that's definitely what we're going to be watching out for as well. How do those divergences play out? Because we're already starting to see that, particularly between the UK and European markets, and perhaps there's potential for European bond markets, for instance, to outperform their UK counterparts if we do see, in fact, the ECB going much slower than the BOE and the Fed and the rest of them.
Christine, thank you so much. Christina Keenor, Nicola Mai, their portfolio manager for sovereign credit at PIMCO, joining us both this morning. Now let's get straight to the Bloomberg First Word News. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. Russian President Vladimir Putin has lambasted the U.S. and its allies for deceiving Moscow over the expansion of NATO, but suggested further talks may still yield a resolution to its concerns. As tensions continue in the region, Putin met with Hungarian leader Viktor Orban, while UK Prime Minister Boris Johnson promised aid on a visit to Ukraine. Goldman Sachs says recent oil price increases could mean OPEC Plus delivers bigger supply increases than expected when it meets later today. The group is expected to ratify another 400,000 barrel a day increase for March. Output lately gained last month amid chronic struggles among members and renewed unrest in Libya. The UK government has published a long-awaited plan to reduce economic inequality, shifting some decision-making powers away from London and seeking to boost pay and productivity in poorer regions. Leveling up the country was a key catchphrase in the Conservative Party's election-winning campaign of 2019, as Boris Johnson's administration seeks to move the agenda on from Partygate scandal. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine.
Angel, thank you so much. Coming up, we turn to tech earnings as Alphabet beats on sales and profits. PayPal, though, plummeting as it posts a slower than expected finish to the year. We'll have a full roundup of what it means going forward. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
The capital markets can really help the shift to sustainable and decarbonized global economy. What are you noticing in that as ESG is now the buzzword literally everywhere?
It is definitely the topic of conversation in most meetings I have with company CEOs, with investors, with industry groups. It's amazing.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now let's turn our attention to tech earnings. Google parent Alphabet has risen in pre-market trading on the back of beats on sales and profits. PayPal plummeted, though, after saying growth in spending on its platform actually slowed during the fourth quarter. Well, joining us now is Alex Webb from Bloomberg Quick Take to actually make sense of all of this. So first of all, there's a definite, divergence. If you disappoint, you get pummeled. If you maybe do better than expected, then investors are piling on.
Yeah, a lot of these tech stocks have really benefited over the course of the lockdowns from a flight to what is seen as quality, but also growth. They were still delivering growth. Low interest rates meant that was a good place to find some, leave your cash for the moment. That's starting to change a little bit. With the case of Google, they're trading at a premium to the market, but not as great a premium as, say, Apple or Microsoft, so they have more headroom. Facebook is actually more or less in line with the rest of the market, so it'll be interesting to see what happens with them later this week. But a company like PayPal, where growth is massively slowing, that they are being punished as a consequence.
Stock split, talk to me about that for Alphabet. How does it compare to others?
So Apple did a 4-to-1 stock split recently. Google is doing a 20-to-1 stock split. That'll mean that a $2,700 a share stock will go to something like, depending where the share price develops, $13, $14. So it does make it more accessible, particularly for retail investors, if they can get over the fact that Alphabet is the name of the company, that you're looking for Google, but there might not be exactly the result that you want.
I mean, this is what everyone, actually also the newsroom, does every morning, the post-earnings. PayPal, now that didn't do so great. The share price pre-market is actually getting pummeled, but is this because companies use them less to actually pay for their goods?
There's a couple of different things going on here. Google obviously had good results because advertisers are trying to get them to spend money on their brands, but some of that spending is going back to brick and mortar retail. So if you're PayPal, not as much, or the pace of spending growth is not as great online. Their key customer has historically been eBay. They used to be part of eBay. eBay has been slowly shifting away from PayPal, gradually shifting away from PayPal, and all those things are starting to have a toll.
So today we have Meta, formerly known as Facebook. I mean, is that also going to confuse investors?
Yes, it's a slightly different story from Google or Alphabet because although they are both ad tech stocks, Facebook, people suspect, are going to be more heavily impacted by Apple. Apple has cracked down on data sharing on its smartphones, on iOS. Facebook may be more impacted by that. That does also mean potentially, though, that expectations are not necessarily that great. So, a beat, even slightly to the upside, will be rewarded, presumably.
I mean, you had the killer question for our analysts, which was, what are some of these tech stocks? Are they value or growth stocks? Is that going to be underpinning everything that these companies try to sell themselves as?
I mean, they have been selling themselves fundamentally as growth stocks, right? But the value that you can get from them, Apple's sitting on about 100 billion of net cash when you've got a 3 trillion or 2.6 trillion market cap, doesn't necessarily move the needle all that much. So they need to be selling, or they have been selling themselves as a growth stock, or perceived as a growth stock at the very least. That means that if there's any wobble in the growth, they are punished. Now, there is still value to be found, a lot of people are saying, and 3-4% return, which maybe you can get if you've got 100 billion cash and market cap of 3 trillion, maybe not so bad as sort of interest rates elsewhere increase.
Alex, thanks so much. Alex Webb there from Bloomberg. Quick take looking at technology stocks. Now, coming up, Chile's finance minister, Rodrigo Cerda, joins us to discuss the country, its economy, and the incoming government led by the recently elected Gabriel Boric. Well, that conversation is up next. We also talk markets, changing some of their views, of course, on what we heard from the Fed. The Fed, we had 6 speakers this week, a lot of them trying to talk down some of the things that we heard, the messaging that we heard from Jay Powell. If you look at the futures on the NASDAQ, jumping 1%, and it's clear that, of course, we had a lot of companies reporting better than expected forecast earnings, dip buying returning to technology shares. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down, the manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Talking down the hawks, Fed officials downplay a 50 basis point hike in March. U.S. stocks post their best 3-day rally since 2020. Santander pledges profitability growth this year, while the Spanish bank hopes to benefit from rate hikes in Brazil and the UK. We hear from our interview with Anna Butin this hour. And as easy as ABC, Alphabet beats on sales and profit. The tech giant also announced a 20-for-1 stock split. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Pre-market, a lot going on, so let's get to Alphabet and PayPal. It's really a tale of two cities. Alphabet beating with estimates both on profit and revenue, and you can see pre-market gaining some 10%. PayPal, not so. PayPal, again, very dependent on eBay, and that has really reduced some of the market penetration in other parts of the world, and PayPal down some 16%. So overall, investors have also been swinging between nervousness over the Fed tightening and confidence in the economic recovery as they navigate this pretty volatile start to the year. We did have a robust earnings outlook overall, helping to ease some of the uncertainty, at least for the moment. So asset classes on the up, with futures on the NASDAQ jumping some 1%. Now, Chile recently elected leftist Gabriel Boric as prime minister. Since forming a government, he's named a diverse cabinet, picking people from all parties and filling the cabinet mostly with women. Now joining us for an exclusive conversation is the current Chilean finance minister. He's Rodrigo Cerda. Mr. Cerda, thank you so much for joining us. Of course, Chile also sitting on a lot of copper. I think it has 30% of the world's copper. What is the one piece of advice that you would give for the incoming government?
Hello. Well, Francis, I think that Chile is trying to give the administration to a new one as good as possible in economic terms. In fact, we're trying to provide a country which is growing in 2021 around 12%. So we expect the next government is able also to continue, not probably such a large growth rate, but we expect they could go on with an important growth. And this is very relevant because in the future we think that we will require, of course, more fiscal revenue to make face to social pressures, which are one of the topics in Chile remain to be closed. Right. As administration, we also have tried to increase pension and so on, but of course, many things are still open.
Minister, last week, Chile's central bank stunned investors with the biggest interest rate increase in about 20 years. This is because of inflation. How much more pain will households have to go through in Chile?
Yes, well, currently in Chile, inflation is around 7%, which is larger than our target. Our target is around 3%. But I think probably the main problem of the central bank is that the expectation or longer expectation of inflation are currently also quite large. So in that sense, of course, central bank need to make the rise in the interest rate as it happened. And also we as the government, we have a budget in which a budget is decreasing around 20%. We're trying in that sense to accommodate aggregate demand such that inflation is not a problem in the future. But of course, we need to make a decision in that sense.
But so, Minister, how long will we have to wait for inflation to start slowing again?
Well, we expect that for the second semester of this year, we are going to see a much lower inflation. I mean, this is expectation. So in that sense, is that we need to now to take actions. And in that sense, the central bank is increasing interest rate, and also the government is decreasing the budget that has a very large expansion last year. But during 2022, well, we need to make the adjustment on the budget.
Chile is also drafting a new constitution. It will be put to a national referendum later this year. And we understand that there's a charter looking at, for example, opening the door to nationalize the country's natural resources. What do you think that means for international investors?
Well, of course, that's a signal we need to take account in our discussion of the new constitution. I think the new constitution is just starting on the discussion. We expect to have a constitution which we have a focus on growth, and to do that, of course, international investment is quite relevant. So in that sense, I think we need to wait and see what is the new constitution. Still, we're in the first discussions.
I know a lot of the focus, of course, is on Chile's central bank. We're expecting, or at least there's speculation about a possible replacement for Mario Marcel to come soon. What's the holdup?
Yes, I mean, we need to make two replacements. On one hand, we need to replace the president of the central bank, and secondly, we need to replace one of the the member of the board of the central bank. Well, we just knew about the Mario Marcel decision last week, so now we are looking to the decision of which is a new member, and then we are going to decide also on the president of the central bank. I think on the next days, probably we're going to see the decision of the government, which is the current government that is going to make those decisions very shortly.
Mr. Cerda, why has it taken so long, actually, to come for a replacement?
No, because, well, we need to, I mean, we have a very good institution in which currently we have a president which is an alternate president which is taking the post. And for the moment, the government, well, is looking to the member of the board and is trying to decide which is the best at this moment. And, well, I think this is a very important decision for the next 4 years. And probably we need to take the appropriate time to make the best decision of all. So probably as I told you, probably in the next few days or week, we're going to make the decision.
Minister, I wanted to get your thoughts, and this is something that we try and debate quite often on Bloomberg TV. At the moment, the price of oil, and actually oil, underpins everything that we're seeing in the economy. As we transition into a greener economy, copper could do that role. And of course, Chile is key for copper mining. How do you see the price of copper, but also the use of copper evolving in the next 5 years and decades?
Yes, well, the use of copper, as you said, is quite relevant in the future for us for us as Chile in terms of our production. As you said, well, Chile is one of the largest producer of copper in the world, and in that sense, well, we are seeing that probably some of our use to copper is going to be made in the future. So in that sense, probably we're going to try to expand our production. In fact, Codelco, which is the larger firm, is trying to make an investment in that sense. And probably the copper price is going to remain not as high as we have seen, but is as a very fair price in the future. This is a good news for our economy, but this is also good news for the world in the sense that Chile is going to continue producing copper and providing for the new users that is going to be required.
Minister, as always, a pleasure to speak to you. Thank you so much for joining us. Rodrigo Cerda there, Finance Minister of Chile, joining us for an exclusive conversation. Coming up, a new study found that just 28% of women feel confident investing their money. We'll discuss the barriers that stop women from investing and how we can build a more inclusive investment industry. This is Bloomberg.
also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
I mean, 2021 has been an excellent year. We're on track to meet our 2019 targets in spite of the pandemic, with profitability near 13%. Very importantly, it's been a pivotal year for us in capital as we reach the 12% fully loaded that we're actually targeting 11 to 12. So we, all in all, have delivered excellent performance across all our regions. North America and Europe doubling profits from last year, Brazil and Chile being the best bank in the markets in profitability, and interest rates actually would help us. So we are positioned for higher rates. We believe that's going to happen across all our markets sooner or later, depending on where. And so we're very excited about the future because we're also investing for the future, delivering today, but also getting ready for what is coming over the next few years.
Anna Butin, today, what's your message actually on capital to investors? I know in the past you've said that there has been a lot of pressure from investors, but that the risks are just not the same for Santander because you're a retail bank compared to some of the large investment banks.
So that's precisely the point. You know, our scale and diversification are competitive strengths that continue to make us different. So revenues were strong across all region segments and businesses. We had a standout performance in the US with 24% return on tangible equity. A few years ago, it was other regions that were doing better. And that's the reason why 12% fully loaded for us is not just enough for us to continue growing. It's enough to increase returns to shareholders. And it's enough to have a very strong, rock-solid balance sheet. And that is really important. So we announced this year, and that's a first for Santander, buyback of our shares. If you consider buybacks and dividend, we're around 6% yield, and we believe investing in our own shares, again, it's a first for us. It's an excellent investment of our capital.
Anna Butin, talk to me a little bit about some of these inflationary pressures that we saw, especially in Spain, and also GDP growth was not as strong as expected in Spain. Is there a worry that Europe goes into stagflation, and what does it mean for your cost pressures, and also having to increase people's wages?
So in terms of cost pressure, I think that's where we are undisputably one of the leaders. Our cost income at 46, targeting 45%. But very importantly, the way we're doing our changes in our business model is going to allow us to be much more efficient, but also to allow us to grow, right? So inflation is net, if it's not too much, it's actually a good thing. I mean, having negative rates is not ideal, not just for us, but for the economy in general. So progressively, as we're doing, going to a bit higher rates is actually good as long as we don't do it too fast, of course. We're positioned for higher rates. And the key here, there's a few things, right? The supply chain knots need to be resolved. Consumer spending that has been channeled into goods should be now going to services. This is great for Spain, by the way, because 13% of our economy is in tourism. The key here, of course, at the end for me is wage pressure and to some extent, of course, energy prices also. So if we can manage those items, I know there's quite a few there, I think inflation, ECB is still targeting 2% for 23, which means that the pressure in the, at least in Europe, is going to be less than in the US or the Americas.
But so are you looking at increasing wages?
In some markets, for sure, but we're more, we've committed to another $1 billion for 21, 22 of cost cutting, of reduced cost, again, by changing the business model. But at the end, what matters, Francine, is that we're increasing revenues more than cost, what you call operating leverage. It's a positive operating leverage. That's the key to any business. Growing revenues at 7 and cost at 3 is okay. The opposite, of course, would not be good. And that is exactly what we've done this year in 21, and we aim to do again in 22. Grow revenues, grow customers. We grew 5 million customers to 153 million total, and growing revenues, being very careful about cost. In Europe, we will reduce cost again by changing the business model and building platforms together.
Santander Chair Ana Botín there speaking to us a little bit earlier on the Spanish bank's results. Now, if women invested at the same rate as men, the global fund management industry could have had more than $3 trillion in additional cash to allocate last year. That's according to a new study by BNY Mellon Investment Management, and the report found that almost 9 in 10 asset managers admit their default investment customer is a man, and just 28% of women feel confident investing their money. Well, we're now joined by Christina Church, Head of Responsible Strategy at BNY Mellon Investment Management. Christina, a lot to unpack in this report. First of all, if women invested, is it just an additional pool of capital because it's their own money, or is it the same pool of capital that they just go to, the husbands or dads or a male within the family unit to invest for them?
Yes, what we found with the report was that there is this gap and that women aren't investing at the same rate as men. And that, as you said, that there's over $3 trillion of capital that could be available were women to invest at the same rate as men. And our report was a global study. We think it was the first of its kind to really look across a broad breadth of asset managers. We surveyed 100 asset managers covering $60 trillion dollars under management. But we also surveyed 8,000 people globally to really understand how they invest and why they invest. And this showed up the gap of $3 trillion. But what was also really interesting was,
Yeah, it might be different in some Asian cultures compared to European cultures. Do you see a societal difference in where women invest more?
Yes, we actually found that in the report, that there were some significant differences. And actually in two regions in particular, in China and in India, we did find there wasn't such a significant gap, that women were investing at the same rate as men. And that is societal differences. But of course, it doesn't necessarily mean as many women are investing as men, and that can still drive change. And we do think there's things that we can learn from the regions where women are investing. And maybe that's where there's better education for young women to really understand the importance of investing, or societal differences between who invests in the family unit. And yet it was very striking to see the differences globally.
Yeah, so why are women not investing? And as a big asset manager, what can they do about it? Because this is, money, like low-hanging fruit for them if women were investing more.
Yeah, absolutely. And we found there were 3 key hurdles to why women aren't investing. The first was the income hurdle. It's interesting that women felt that they needed to have $50,000 per annum in disposable income to start investing. But there was also this confidence hurdle. And that, for us as asset managers, we believe we can engage better with women to teach them about investment, and also as an industry to use better language to inspire women to invest. So we've got the income hurdle and we've got the confidence hurdle. But there was also a risk hurdle, the idea that investments associated with higher risk. And just 9% of the women that we surveyed said that they were confident investing in high-risk areas.
Christina, do you know if when women invest, do they invest differently? This is something that I've heard from the leadership at some of the big Swiss banks in saying women, when they tend to invest their own money, actually they're much more longer term. They think more about ESG. Is this a wrong blanket statement, or do you see different patterns on what they try to achieve with investments?
Yes, and obviously everything depends on the individual and their own personal values. But what we did find was that overall, over 50% of women would prefer to invest or invest more if that investment aligned with their personal values. And also, a significant proportion of women would like to invest if that investment could do some good, make an impact in the world. And that's where we see there's a significant opportunity that $1.9 trillion could be unlocked if women were to invest at the same rate as men. A lot of them would invest aligned with responsible investing, and that could drive so much change in the world. That could really help not only the women's prosperity for the future, but shared prosperity. It could do good for environment and for society as well.
Right. And it's just big money for asset managers. Christina, thank you so much. Christina Church, their Head of Responsible Strategy at BNY Mellon Investments. So now let's get straight to your Bloomberg Business Flash. Here's Angel Feliciano. Hi, Angel.
Hi, Francine. Alphabet shares have jumped on earnings that topped estimates and a 20-for-1 stock split. Fourth quarter sales, excluding partner payouts, rose 33% to almost $62 billion. Gains were driven by advertising and a focus on e-commerce. Cloud revenue only narrowly beat the street, in another sign the division's growth won't overtake Amazon or Microsoft anytime soon. AMD stock rallied as much as 12% in late trading after giving a surprisingly strong sales forecast, suggesting it's making further gains on rival Intel. The chip maker's first quarter sales outlook outpaced Wall Street estimates as it reached a level of profitability that's nearly identical to Intel's, something that would have been inconceivable just a few years ago. And that's your Bloomberg Business Flash. Francine?
Angel, thanks so much. Coming up, oil near 7-year high. That's as traders count down today's OPEC Plus meeting. We'll have plenty more on that shortly. This is Bloomberg.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now, oil steadies near a 7-year high ahead of today's OPEC Plus meeting. It's expected producer nations will ratify a modest output hike. But the big question, of course, is whether the alliance can actually deliver on the target. Well, joining us now is our executive editor for energy and commodities. He's Will Kennedy. Well, first of all, I mean, this is something, if you've been covering OPEC for quite a long time, we used to talk about compliance. Now is that they can't put enough barrels out there, although they said they would. So what's the problem?
That's exactly right, Francine. There's no problem with cheating at the moment. The problem is with meeting their commitments. And, you know, last month, according to OPEC figures, they overcomplied by 122%. So clearly they're struggling to perform. I think outside core countries in the Gulf, Saudi Arabia and UAE, to some extent Iraq, many countries are struggling from the rebound from the COVID crisis, where oil demand crashed 25%, prices went negative, and OPEC was forced to introduce very, very stringent output declines. It takes time to bring capacity back. It requires a lot of spending. It requires a lot of drilling. Many people's fields are getting quite old. So it's showing that the industry and many OPEC members is not as sprightly as they would wish.
So, Will, what are you actually expecting today? And if they were to put more, barrels of oil on the market, it's just up to the Gulf states who are the only ones that could manage.
I mean, up to a point. I mean, we are seeing some degree of catch-up. Nigeria managed to increase 100,000 barrels a day in January, which was a big increase for them. Russia is falling short slightly, perhaps by about 50,000 barrels a day from its target, but it is increasing production. So there is more barrels coming from places outside the Gulf, but it is slightly heavy going. What do we expect from today's meeting? We expect them to stick to their plan, which is to introduce another 400,000 barrels a day, at least, on a target basis. We probably won't get all of that, but we'll get a good proportion of that. This is clearly a market that needs that oil. We see prices close to $80 a barrel. We see the spread between short-term and longer-term contracts at very elevated levels, a signal that oil is needed now.
Well, thanks so much. Will Kennedy there, who oversees all of our oil coverage, and of course we'll be keeping a very close eye on OPEC+. In the meantime, we're getting inflation data out of the Eurozone in a couple of minutes, a good indication of what we could see for the ECB tomorrow. It's all about sequencing, so less than rate hikes, it's how we see quantitative tightening and how that plays out in the markets. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller and Kay Lyons in New York, or Anna Edwards here in London. This is Bloomberg.
That it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
We're probably in for a less rough month or a less volatile month in February than we were in January, purely because a lot is priced in already.
The good news is that markets have been aggressively repricing future tighter money supply and tighter Fed policy.
I would be supportive of 25 basis point increase in March. Could we do 50? Yeah, should we? Well, I'm a little less convinced of that right now.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Wednesday, February 2nd. Our top stories today. Global stocks head for the biggest four-day rally since 2020. Meanwhile, Fed officials signal they won't be rushed when it comes to raising interest rates. A tale of two heavyweights. Google's parent soars on earnings and a stock split. General Motors, though, is little changed, even though the chip shortage is easing. We will talk with the automaker's CEO, Mary Barra, later today. And happy days are here again on Wall Street. It's been more than a decade since investment bankers have seen bonuses like the ones being handed out now. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, we're still talking about the Fed. We will no doubt do that daily until we get to the March meeting and beyond. But at least we have the tech earnings season to throw into the mix again now.
Yeah, and tech earnings benefiting this market in a big, big way, Anna. Of course, in Asia, it is less so given the fact that there's a lot of regional stock exchanges that are closed due to the Lunar New Year holiday. That includes China, Hong Kong, Malaysia, Vietnam, Taiwan, South Korea. You get the picture. A lot is not open for trading right now. There's just a few gauges that contributed to the 1% move higher for the MSCI Asia Pacific Index overnight. One of them being Japan, where stocks rose about 1.7%. A big contributor to that was Sony, out with a really strong quarterly report. Also raised its full-year outlook, benefiting in a big way from that new Spider-Man movie that was so successful. Admittedly, I have not yet seen it, but it is lifting the stock today up about 5%. And then one story we continue to follow is what's going on in the subcontinent, in India, where they announced a borrowing plan that was a lot wider deficit to GDP than economists were expecting. That saw the 5-year yield moving up 10 basis points yesterday. It's up another 8 basis points today, north of 6%, Matt.
All right, so we are seeing really a bullish outlook, and actually stocks have done really well. You can see futures right now up 0.8% here, and on Friday, when we kicked off the session, the S&P was trading around 4,300. Yesterday's close, 4,550. So we've come a long way in 3 trading sessions. The 10-year yield right now coming down as investors buy up that debt a little bit, but still at 178.40. NYMEX crude coming down, also little change though, and WTI is trading for $88 a barrel. So still at a relatively high level as we await the results of the OPEC meeting. They want to raise production, but can they actually produce more? How much spare capacity do they have? Bitcoin is down from the trade at midnight tonight, but still at 38,534. So it's still slightly more than it was at this time yesterday. Maybe that also is a bullish indicator, Anna.
Yeah, absolutely. Matt, let's get to some breaking news. We've got European equity markets moving to the upside. Euro area inflation, we get the final data on that today, or we get the updated data for the region as a whole, if you like, jumping to 5.1%. Economists had expected 4.4%. I would wonder how current that expectation, that estimate was in the market, because we'd already heard from Germany and from France and from Spain and I think from Italy as well. So with all that knowledge about how high inflation was for those individual component countries, was perhaps that estimate estimate a little backward looking. We will see whether how the markets respond to that. Not really throwing the markets off their stride, if you like, when you look at equity markets all moving to the upside. Travel and leisure is a sector that is moving higher today, up by 1.6%. Interesting posting on our Markets Live blog from the team talking about how this is a sector that still underperforms the other reopening trades that have started to benefit, of course, as the pandemic has faded. Matt was talking about WTI. I've got Brent in here just underlining we have that OPEC Plus meeting, backwardation, illustrating the tightness of the market at the moment, that high price for current oil versus future delivery. Novartis is in focus. In fact, Swiss earnings in focus very much today, and perhaps to the downside for these stocks, or certainly to the downside for these stocks. So Novartis down by 2.5%. The drug makers' numbers being described by one analyst as underwhelming. A lot of focus on whether we'll get that private equity interest in their generics business. A big scoop from the Bloomberg team overnight on that front, the CEO having to address those questions. Julius Baer down by 0.5%. The banking business in Switzerland, the buyback, it seems, disappointing a few investors, or some investors in the market, Kaylee, given buybacks from banks such a big theme.
Yeah, and that was a big theme with UBS yesterday, which fared a lot better in the European session. Now let's take a look at what is ahead today, and the European Union will finally unveil how it will label investments in some gas and nuclear projects as sustainable. A big focus on climate there. Then not so much sustainable energy, fossil fuels. OPEC Plus will meet to discuss its oil production strategy later on today. We'll also get some U.S. data, including MBA mortgage applications and ADP employment change, setting us up for that payrolls report come Friday. And finally, tech earnings will continue after the bell. Meta is next to report around 4 p.m. New York time, Anna.
Okay, certainly a focus on that. More on Meta in just a moment. Let's start with Google's parent, though, Alphabet, posting fourth quarter sales and profit that beat estimates. The results showing the resilience of its advertising business as the pandemic persists. Lots to talk about then when it comes to the Google parent. The stock splits, very key here as well. Laura Wright has all the details. Laura, good morning. What were the key takeaways then from Alphabet, and were there any surprises?
Yeah, there was a surprise, a stock split 20-for-1. That's why we're seeing a surge in pre-market trading, up double digits price action of Alphabet. The CEO, Ruth Porat, outlining a 20-for-1 stock split. They want to make Alphabet more accessible. They think that could potentially open up new avenues for the company. The estimation is that it will bring down the share price of Alphabet to around $138 from yesterday's level of $2,700. That is a significant decrease. Now, the bread and butter for Alphabet remains the advertising business. We were already seeing the structural tailwinds before the pandemic. That is certainly being accelerated. Fourth quarter advertising revenue landing at $61 billion, an increase of over 30% year over year. YouTube was notably disappointing. Comps were tough, stiff competition from other video platforms. Looking ahead, the cloud business, yes, competition is tough, AWS, Microsoft, Azure, but there is growth for all players in the market.
Yeah, so generally good news then. What are we expecting from the company formerly known as Facebook later today?
Well, investors have some uncertainties about what announcements we might see surrounding the metaverse. One thing that is sure, Matt, is that Meta trades inexpensively, 20 times forward earnings. Compare that to where Amazon is at, almost double on a forward earnings level. I spoke with one owner of the stock earlier today, Freddie Late, CIO at Latitude Investment Management, and he might be circumspect and a little uncertain about the metaverse, but he compares Meta platforms to Tesla, saying the way Tesla forged ahead with EVs, the market has followed. And if we think about the metaverse in the same way, what we've seen from Microsoft, their acquisition of Activision Blizzard, if Meta Platforms is going to lead the way in the metaverse, then yes, others may follow.
Well, then that's the question. Will Meta, just because its name is Meta Platforms, doesn't mean they'll necessarily beat Google, Microsoft, Amazon to the punch. So will definitely be interesting to watch. Laura Wright, thank you very much for that. Let's get to cars. General Motors is seeing signs of the semiconductor shortage easing, but the automaker cautions profit for 2022 may be little change. Let's get more with Bloomberg's Global Autos editor, Craig Trudell. And actually, Craig, they're not seeing it ease too much until the second half of 2022, are they?
Yeah, I think that's the key. I do think that this is going to be a year of trade-offs for the whole industry, right? Where if we do get this hoped-for easing of semiconductor supplies, you're going to see some trade-offs in terms of pricing. We've seen the industry in this very production-constrained environment really be able to take advantage of pricing to a massive degree. And you're going to see, that change potentially to some extent when we do have, dealer lots that are not as sparse as we've seen for the last few months. So, what we sort of gain in volume will potentially give up to some degree in pricing.
Okay, Craig, so obviously automakers are grappling with the chip shortage. They are also trying to figure out how they can most quickly and effectively make the transition toward electric vehicles. We heard Ford yesterday, Bloomberg reporting, is going to spend another $20 billion towards that effort. Is this just a race to see who can spend the most the fastest to compete with Tesla?
I think we heard it from Mary Barra last night as well, and it absolutely is the case. And I think, what we're seeing is a challenge on the part of these automakers of just how much they're going to have to spend to take, their manufacturing network globally and convert them from making combustion engine models to electric vehicles. These are companies that have significantly more experience than Tesla from a manufacturing perspective. But even with all this built-up knowledge and the resources that they have, it does take a significant amount of time to make those transitions. And for these companies to catch up and compete with Tesla, they really have a sort of tall order in the sense that Tesla is now making more models, more vehicles a year in California than any auto company made in one of their factories in the U.S. last year. And they have more capacity coming online, right? They have, the Austin plant opening this year, a factory opening in Germany. So, the race is on for the electric vehicle sector.
Okay, we are still watching that battle between Tesla and now the volume manufacturers. Craig, thank you very much for that. Bloomberg's Global Autos editor, Craig Trudell. And on the subject of cars, don't miss our interview with Mary Barra, General Motors Chair and CEO, at 9 a.m. at New York time. Now, after a flurry of diplomatic talks yesterday, Russian President Vladimir Putin has suggested further talks could help diffuse tensions over Ukraine. Meanwhile, Bloomberg's learned that the Biden administration is willing to discuss letting Moscow verify there aren't missiles at NATO bases in Romania and Poland that could hit Russia. Anne-Marie Hordern, Bloomberg Washington correspondent, joins us with this fascinating story. Where do we stand then, following all of these diplomatic talks, these words from President Putin about what difference talks could make, and this offer from the Biden administration, Anne-Marie?
Well, there's going to be more diplomacy, and it does seem like the Biden administration at this moment potentially dangling that carrot of giving a way for Russia to verify whether or not there are these missiles at sensitive NATO bases, which actually President Vladimir Putin discussed yesterday. In his remarks yesterday, he did leave this door open that he wanted to engage in diplomacy. He said even though he knows it's not going to be easy, but he did say that the United States ignored his main security concerns. When it comes to more high-level diplomacy, President Putin, who we should note, we have not heard him discuss this matter since before Christmas when he gave his year-end news conference. He also signaled potentially President Emmanuel Macron of France could be visiting Russia. And then off the heels of his trip to Kiev, today, Prime Minister Boris Johnson will be speaking to Putin. So it does look like at the moment, the train is still moving in the direction of diplomacy, which many are thinking that at this moment, at least that is optimistic.
Well, we are getting some headlines from the Kremlin now, Anne-Marie, saying Putin cited very cautious optimism on security talks and that Russia has plans to minimize possible sanctions impact. So we will continue to follow that on the geopolitical front. On the domestic front, let's talk about that U.S.-China competition bill that once had bipartisan support. Now there seems there's more Republican pushback. Is there a real chance here that it doesn't make it through Congress?
I think it will make it through Congress, but as you noted, Kaylee, having some of this Republican pushback means that it's going to be a bumpy path forward. A version of this bill has already passed in the Senate, but now you have House members, Republican members, saying that it doesn't talk tough enough on China, especially it doesn't curb some intellectual property theft. They don't think it does enough in terms of China's record on human rights, as well as they have a little bit of issues with some of the provisions on climate. But this is key for the Biden administration to see this over the finish line. And we've been hearing from Secretary Gina Raimondo and her lobbying to the GOP is that, listen, they're not going to agree on everything together. That is what bipartisanship is all about in Washington. But if you can get it over the finish line at the House, it's going to have to go into a conference, into negotiations with your colleagues in the Senate. And that is where you can make these changes. So it does look like it is set to pass. We are going to get a procedural vote today and then a possible passage vote on Friday because it has the Democratic votes to pass, likely. But the real issue and the real negotiations will come after it clears the House and how they're going to find a compromise with the Senate.
how long it takes the sausage to get made. Thank you so much to Bloomberg's Anne-Marie Horder in Washington for us this morning. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. A big one to the downside, PayPal. That stock is plunging the better part of 17% after having its slowest payments growth in about 2 years in the fourth quarter. The CFO calling it a much slower than expected start to the year end to the year. Plus 2022 outlook came in disappointing. So that stock taking a pretty bitter punishment as a result of that. Another stock moving to the downside is Match Group. Revenue came in short of expectations. Obviously, the Omicron variant may be having a little bit of an impact here on people's desire to date and socialize. That stock is down about 5%. One more positive story, though, is AMD, the chip maker, which is a big rival of Intel, becoming more profitable, topped expectations. As a result, that stock is up about 11% before the bell, Anna.
Yeah, talking about secular growth over the next 5 years, something we're thinking about when you talk about time horizons for tech investing. Now, coming up on this program, euro area inflation unexpectedly hits another record, testing the ECB's stance. We'll discuss this and more. Mark Haefele joins us, UBS Global Wealth Management CIO. That conversation shortly. And big bonuses are back on Wall Street. More from our big take, that's straight ahead. Plus, don't miss Bloomberg's monthly series, Chief Future Officer. Tonight's episode features Mondelez CFO Luca Zaramella and airs tonight at 9 p.m. New York time. You can also check out our interview with the Macy's CFO Adrian Mitchell, available right now on Bloomberg.com and on YouTube. This is Bloomberg.
What do you think is the impact of the Prime Minister on the market?
As Mr. Suzuki, who is the Financial Services Minister, he mentioned at his own press conference, and share buybacks is widely used to return profits to shareholders and improve ROE. And how to share out the profits from growth is, totally the decision of the management of each company after carefully taking, all the stakeholders into consideration. And I believe Mr. Kishida has a quite cautious stance on the uniform regulation of share buybacks. And I think because he is giving a consideration to each company's, individual circumstance and, decisions.
Earnings season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And just as we thought we could turn our attention away from central banking and towards the earnings season, we realized that we still need to focus on inflation. We have a chart here showing Eurozone inflation, Euro area inflation unexpectedly accelerating to 5.1% in January. We just got this update at the top of the hour. Let's get to Christine Aquino, who helps lead Bloomberg's markets coverage and joins us here on set. Christine, good to speak to you. So we had been expecting this number to moderate accelerate a little. I do wonder, though, if some of those expectations were a little stale, given that we'd already heard from Germany with the blowout inflation figures there, and from France, and from Spain. What did you make of this this pretty hot print?
Yeah, Anna, it's a whopper. And in terms of kind of the discrepancy with estimates, it's potentially possible that, yeah, they are quite stale. And I guess it also generally speaks to just how much inflation is really taking hold in Europe, and that's exceeding all of these expectations that had already had to be upgraded from the very low levels still at the end of last year. And so, yeah, it really just kind of drives home the fact that whether or not it's transitory, it's beside the point. The levels are what they are, and the ECB will have to respond to them potentially as soon as tomorrow.
Yeah, I mean, the Daybreak newsletter told me this morning that the CPI number would come in above 5%, and they were correct. So I recommend everyone check it out, DAYB Go. In terms of central bank reaction, you know, a week ago, John Farrow was asking his guests on Real Yield if the ECB would raise rates, and all of them, without exception, said no. Is that opinion changing now?
Well, certainly when it comes to market pricing, Matt, the answer is yes, for sure. Because this week alone, we saw that pricing expectation for the ECB really ramping up. Markets are now pricing for a 25 basis point worth of rate hikes from the ECB by the end of this year. Of course, we know that they've been moving in 10 basis point increments, but the total number of tightening that markets are expecting from them is now up to 25 basis points. So that would take the deposit rate from a minus 0.5 level right now to double that, minus 0.25%. It's still negative, but it's definitely a material change. And if it does come to fruition, it will mark quite a bit of a change from the ECB, given that they've insisted that they're not going to deliver any rate hikes this year.
Christine, is this now a market that has made peace with the fact that maybe central banks will tighten more than expected and is back to focusing on the fundamentals in the earnings season, or no?
Well, Kaylee, I think they're still in the process of repricing those central bank expectations, but of course, having to keep an eye on the earnings season as well. And I think it really is all about kind of the interplay of these macro factors that both companies on a more ground level are dealing with. We're talking about inflation issues, right? When it comes to how that's affecting their margins. And of course, that's also a conversation for central bankers. How are they going to be guiding policy, and how they're going to be approaching this tightening process when they're contending with inflation that is exceeding even their own more bullish expectations.
Christine, thank you very much. Bloomberg's Christine Aquino. All the excitement building then ahead of central bank meetings here in Europe this week. For more market analysis, check out MLIV Go. That is the function on your terminal to track the Markets Live blog. This is Bloomberg.
Is this going to primarily be chips for your own business, or is this going to be more centered around the foundry business and external customers?
It's going to be both. And what we said today is we're announcing 2 fab modules. It's a large location, 1,000 acres, because I'd hope to build out a full 8 fabs or more on this location. And you know, if we do that full project, it would be $100 billion over the course of the decade or so. So a massive project. Initially 3,000 jobs, 7,000 construction workers, supply chain, et cetera. I mean, this is just fabulous. And the products will be our most leading edge chips. So as we said, this will be the angstrom era when we're going to 2 nanometers and below into the angstrom era. So it'll be the most advanced chips, potentially the largest manufacturing location in the world. We'll use its output for our internal products, but also for those of the foundry customers as well. So it's going to cover both.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Caitlin Lines with Matt Miller in New York and Anna Edwards in London. Now let's get the first word news. And the Biden administration is lowering expectations for this week's jobs report. The White House says that brief absences of workers due to Omicron could overstate the number of unemployed people for last month. Surveys for the January payroll numbers were said to have been taken as coronavirus cases soared. British Prime Minister Boris Johnson is trying to re-inject momentum into his government in the midst of that damaging Partygate scandal. Johnson has revealed a long-awaited plan to reduce economic inequality in the UK. It would shift many decision-making powers away from London and seek to boost pay and productivity in the country's most deprived regions. OPEC and its allies are expected to approve another modest oil output increase today. At the same time, they'll have to struggle to deliver. In November, the group only implemented about 60% of its increase. Members from Nigeria to Russia have been running out of spare capacity, and it's difficult for them to revive output after years of cuts and underinvestment. And in pro football, a family feud is leading to the sale of the Denver Broncos. The late Pat Bowlen had the team in a trust before he died in 2019 and laid out the terms of succession. 2 of his children then contested the agreement. The Broncos and their stadium could bring in more than $4 billion. And I have to say a brief disclosure here. The Broncos are my team. And Anna, you don't have to talk to me about NFL football, but I will just say I am hoping that the new coach, now that Fangio's out, and new ownership may turn things around for us next season.
You should buy them,
Well, I wish
Kaylee.
if only, Matt. Good luck, Kaylee.
We could do a GoFundMe for you.
When we come back, we'll get back to the market conversation. Maybe he knows a thing or two about American football. I have no idea. Mark Haefele joins us from UBS. This is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty.
I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada, 1-2 itu ada. Tapi nggak kayak dulu, kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu, 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 itu nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
From New York City.
When you're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening. So recap the headlines.
You do not want to miss this
How
story.
are you thinking about those dynamics?
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Here is what you need to know. Global stocks are extending their winning streak. A rally is now in its 4th day and is the biggest in more than a year. Investors have been swinging between nervousness over Federal Reserve tightening and confidence in the economic recovery. Fed officials signal they won't be rushed when it comes to raising interest rates. Shares of Alphabet surging today. The Google parent announced plans for a 20-to-1 stock split. That will make Alphabet easier to buy for retail investors. Meanwhile, General Motors sees this year's profit little changed. Coming up later today, we will speak with the GM CEO, Mary Barra. And it is the good old days for Wall Street rainmakers again. Bonuses at the big Wall Street investment banks haven't been this big for more than a decade. Top bankers will with 8-figure payouts as their employers vow not to be outbid for talent. More on that war for talent coming up straight ahead. That is a look at what you need to know this morning. It's a mixed bag, Matt, when it comes to stocks and Fed expectations and Wall Street payouts and earnings stories. Lots to discuss this morning. What's in focus for you?
Well, we're on a run, actually, Anna. If you look at the S&P on Friday at the close, we were down 7% year to date, and now we're down 4.5% year to date. So it's been a good couple of sessions, and we're looking at futures rallying strong again, 0.8% right now. So it looks like risk on today. On the other hand, investors are buying bonds and pushing down the yield. Only a bit, but it's down nonetheless to 1.7840. By the way, I think a bit and a lot, I guess that's a little bit ambiguous. General Motors came out with profit of 135, and I heard a lot of reporters saying that was only a little bit more than the 120 that was anticipated. Feels like a lot more than me. Also, General Motors could earn $15 billion in profit this year. That's still a lot more than $13.4 billion last year. So I think we need to decide how we grade these things. NYMEX crude is up now, 88.42 a barrel, and that's for WTI, so it's a relatively high number, and Bitcoin trading at 38,562. Kaylee, what do you see in the pre-market movers?
Well, I'm going to recruit someone to make you a rubric, Matt, of how we grade these things. But you mentioned GM. It is moving higher in pre-market trading, though to a lesser extent than some others. It's only up about 0.9% at this point. Much bigger moves for the likes of Alphabet. Really a blowout quarter, beating across the board on advertising, on YouTube, on cloud. Plus, we have that 20-for-1 stock split. As a result, that stock is up nearly 11% in pre-market trading. Also higher by a little more than 11% is AMD. Also a strong forecast, greater profitability, showing it's really really getting more competitive with Intel. Plunging to the downside, though, PayPal, slower payments volume to end the year last year, plus the full year outlook for this year coming up short. So as a result, that stock is down about 17%, just brutal declines before the bell, Anna.
Yeah, quite a focus on technology. Some technology names enter the upside there, Kaylee, and that is translating into a stronger session here in Europe. Some tech names doing well, but also travel and leisure doing well. It's not just the tech sector moving a little higher this morning. Interesting to see that inflation print coming out higher than had been expected, higher than the estimates on the Bloomberg terminal earlier on today for the Eurozone. We have an ECB meeting, of course, tomorrow. Interesting to see how that changes the narrative, even if it doesn't change the very near-time policy settings. 113.05 is where we trade on the euro. That got a boost. The euro did get a bit of a boost on the back of that inflation print. Novartis down by 2.8% for the Swiss drug maker. Underwhelming is the way one analyst described the numbers coming through from this business today, and a lot of questions really over the future of their generic drugs business. To what extent does it make sense to keep that? They are reviewing it, looking at strategic options for it, and we had a great Bloomberg scoop around private equity and the extent to which private equity is coming together to try and make some kind of mega bid for that business. Julius Baer down by 5.8%. They had a record profit figure for the last year, but it was the share buyback that seemed to disappoint some in the market, it would seem, in the context of some of the other buybacks we talked about recently. Kaylee.
All right, Anna, well, let's have a broader discussion about these markets now. Joining us is Mark Havely, UBS Global Wealth Management CIO, who is in Zurich today. Mark, obviously it has been a very dramatic couple of weeks as we've seen a repricing of expectations of just how much tightening we will see from central banks globally this year. Has that been overdone?
Well, I don't think you could talk about it too much, but I think that what investors have dealt with was that really fast move on the 10-year, which typically upsets equity markets. And with that kind of passing through, now they're focused on the Fed. And as you highlighted, part of the Fed's message is they are not going to be rushed. And so in our base case, we see this inflation moderating, and that gives the Fed a little bit of flexibility to hike at a pace that doesn't stop the strong earnings from coming through and doesn't stop the global growth that we should see as we come out of Omicron.
But on the subject of strong earnings, Mark, by and large, they have been, and yet it hasn't necessarily seemed to matter that much. What does this market value more?
Well, look, I think it does matter in some of the sectors. I mean, certainly the most speculative names with the highest multiples or no earnings, they've been hit the worst. And then you look at some of these cyclicals, some of these value names, they've done remarkably well. And of course, sectors like energy are up strongly on the year. So, maybe I'm old school, but I think earnings do matter and will continue to matter.
Mark, good morning. Tell me what you think about the possibility of a 50 basis point hike in March, because the market is focused on how many hikes we get, but also the size of those hikes. And there are some voices at the Fed, and Raphael Bostic one, who do talk about the possibility of 50. Is that just a useful tool to get the markets really concentrating on the Fed's willingness to take on inflation? Do you think a talking point for us? Or do you think it is something that there is merit to doing, to surprising or to outpacing expectations a little in the market?
Yeah, so shock and awe from the Fed in a crisis situation where they're providing liquidity is a good thing. Shock and awe on tightening is probably not a good thing. And I think, some of the internal papers and work that's been done at the Fed about past rapid moves, lead me to believe that is talk to kind of focus the market that really all options are on the table. But as noted, that's probably not the base case for the Fed. And I think it would take considerably, quote unquote, worse data on inflation to make them kind of move that more likely to happen.
Okay. Thinking about another big theme of markets at the moment, and certainly of this earnings season, that is supply chain management. As you look ahead to this year, are you pushing out expectations for when we see normalization of supply chains? What are companies telling you? What is the mood music that you're getting on that front? I mean, clearly there still could be risks of further dislocation as we look at Omicron management in China.
Well, certainly, if we look back to where we were a year ago and things, this has taken longer. And I think, the administration is kind of started to temper expectations about how soon we see some of these things recede. But in our own looks-throughs and what we've seen, there's no question that there is anecdotal signs that these situations continue, and yet some of the inflation data has begun to improve, and we still think in our base case that the inflation picture on the supply side will start to improve, particularly as we get these openings and some of the spending can shift towards services.
How much would you then start to reduce your commodities holdings? I mean, a lot of people had built up commodities in anticipation or to hedge inflation, and if it's going to improve, don't you start to unload?
Well, look, the commodities has been a strong move. We have commodities in the portfolio for several reasons. First, there is the chance that the inflation picture persists and then it can work well. But secondly, there's just the fundamentals of supply and demand. And as we get that reopening, we think the demand is going to be strong because in some ways, this energy transition journey that we're on, we're not quite ready for it. And so, the investment in some of the commodities has fallen off, and yet we have that demand there. And then, of course, I'll add the final element to why we're so interested in commodities and energy right now, given the picture around this Russia-Ukraine situation.
Mark, when you talk to the average Joe on the street, or I guess in Zurich, the average Johannes, and he wants to replace his, the 40 and his 60-40 with something else in a rising rate environment, what would you advise?
Well, look, that is a key question, and that's why we have made very strong inroads and very strong relationships and added a lot on the alternative side because things like hedge funds, private equity, leveraged loans, private loans, these are the areas where we have to go because bonds cannot provide the same ballast in portfolios. And of course, I will, leave it to you to label the average person, but that is the direction that the markets are moving because we do need something to replace bonds in an asset allocation.
Okay, although I watched with interest as one of my colleagues was talking about the reduction in the pile of negative yielding debt that we're seeing globally, which of course we saw that ramp up through 2020 and now seems to be coming down. Mark, thank you so much. Mark Hafley, UBS Global Wealth Management CIO, thank you so much for joining us. Up next, Fiona Boll, Global Head of Commodities and Real Assets at S&P Dow Jones Indices. Lots to discuss there when it comes to commodities. We were just hearing there from Mark about the assumptions there that tensions get dialed back down on the Ukrainian border. What would that kind of situation do to commodities? We will ask Fiona. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Welcome back. This is Bloomberg Surveillance Early Edition. Let's talk about commodities markets and specifically oil today. OPEC and its allies are expected to approve another modest oil output increase today. The big question is whether the alliance can actually deliver on those targets. Joining us now is Fiona Boll, Global Head of Commodities and Real Assets at S&P Dow Jones Indices. Fiona, nice to speak to you. So somebody described these OPEC Plus targets as aspirational, symbolic earlier on to me. Would you suggest so? I mean, what do they tell us, these numbers exactly, if there isn't the ability to actually meet those targets?
Hi, Anna. Yeah, I think that's a pretty good description. Usually we're talking about compliance and OPEC members not adhering to their quotas, but in this case, it's the complete opposite. You know, even if they say that, you know, they want to achieve 400,000 barrels a day extra each month, you know, we think it's likely half of that due to, you know, underperformance and underproduction in some key countries.
What are the spare capacity numbers, you think, Fiona? Because there has been speculation that they really aren't as high as we might think.
Look, as usual, it's really Saudi, maybe the UAE, that has that spare capacity, and we think of the Saudi spare capacity as sort of the shock absorber, you know, and so when do you want to use it? You don't want to maybe use it too early. You know, outside of those two countries, really, you know, inventories are incredibly low, and we don't think there's a huge amount of spare capacity.
Fiona, obviously Brent is dancing around $90 a barrel right now, and more strategists saying there is a path toward triple digits in the not so distant future. How will that change the calculus for OPEC if and when you think we'll get there?
Look, we haven't seen triple-digit oil prices for a long time. You know, it will be hard for some countries to not try and increase production at that level. But as I just said, you know, the constraint might not be, you know, it is more around investment, or should I say underinvestment, and their ability to actually do something, even if oil prices do get to 100.
How do you forecast something like or around an event like Russia invading Ukraine? I mean, what does that do to energy prices?
It's clearly a pretty significant tail risk. If you look at European gas prices, you can see that they're pricing, you know, in some of that risk. You know, if there was any military action, you would have to assume that sanctions will be placed on Russian oil. We've seen sanctions placed on oil before. In fact, we've still got the Iranian sanctions in place. So the immediate impact on prices could be very, very severe.
Okay, we'll follow that then. Of course, influential for the commodity space. Fiona, thank you very much. Fiona Boll, Global Head of Commodities and Real Assets at S&P Dow Jones Indices. Coming up on the program, Wall Street's biggest bonuses in a generation. More from our Big Take story. That's next. NI Big Take is the function to use if you want to read it ahead of our conversation on the Bloomberg. This is Bloomberg.
SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
You also have very favorable comments about the book from Henry Kissinger and Bill Gates. Who's smarter?
Each would say the other guy, and I think I would say each in their own ways.
Boy, you should go into politics or diplomacy. Okay.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons in New York and Anna Edwards in London. We are simulcast on Bloomberg Radio and Bloomberg Television. Now, big bonuses are back on Wall Street. Pay packages at U.S. investment banks haven't swelled this much since the late 2000s, with Morgan Stanley, J.P. Morgan, and Goldman Sachs all raising bonuses for deal makers to the tune of 30%, 40%, even 50%. Sri Natarajan is with us right now, Bloomberg's banking senior reporter, joining us for more on his Big Take exclusive. Great story, amazing reporting in this. The anecdotes are just sick. In terms of how much they need to pay, is that really the bottom line here? Or is it that they can socially release the gates, so to speak?
A bit of both. Yeah. You have to realize that Wall Street hasn't seen this level of excess in over 10 years now. We've gone through a stretch of nearly 10 years when even when banks were making money, they really didn't have the license to pay up because there was just so much scrutiny. But something changed in 2021. 2020 was also a big year for the banks, but that was the year when the pandemic support from governments across the world really unleashed this trading boom, helped revive this corporate deal-making bonanza. But for the sake of optics, that definitely was one of the reasons you saw some restraint. That went away in 2021. The boom rumbled into last year, and you had a lot of people...
There was also a lot of complaining, right? Especially from the lower ranks.
Right. Now, you had a lot of people in their seats saying, we have put in a lot of effort. If you're not going to pay up, we're ready to defect and jump ship. And therefore, you had executives who felt the need to pay up. They talk about this war for talent, and when you look at compensation costs across the banks, you see that they have paid up generously for 2021.
Well, and it's not just a war for talent thinking about Wall Street. They're now competing with San Francisco.
No, and we point this out in the story. About 15 years ago, the CEO of Goldman Sachs was perhaps one of the top earners in the broadest definition of Wall Street. That's not the case anymore. Banks, by and large, are sort of in their relatively impoverished corner of the financial metaverse. You have private equity firms. You have all these tech fortunes, even cryptocurrency, overnight cryptocurrency billionaires. So how do they compete? They're trying the best they can.
Relatively impoverished. I like the way you use that relative terminology, Sri. Let me ask you about how the role of banks in the sort of public psyche, I suppose, and that this will get public attention perhaps, has changed here versus the financial crisis. The financial crisis, the global story around banking was that they were the problem, and the banking sector has tried to cast itself very much as part of the solution as we've gone through the global pandemic, and I wonder if that has changed their ability to do just what you're setting out here.
Let's look at the key difference. The last big crisis, the 2008 financial crisis, the banks were at the center of it. The banks are blamed and responsible for a lot of the problem. Yet, after federal bailouts that prevented or ensured that the banks did not go into oblivion, in 2009, with the market rebound, they paid up for their talent. And that really invited a lot of anger from lawmakers who really said they were being tone deaf. There are some echoes of that in the pandemic because a lot of the boom is tied to some of the government support that came into place in March 2020 and after that. Yet, banks were not seen as the reason for the problem. You know that there are other industries where levels of excess have really shot through the roof, and therefore banks feel a lot more comfortable now, willing to pay up the big 8-digit packages.
Well, and obviously the banks have been benefiting in a huge way from a really positive deal-making environment. Does this kind of acceleration in compensation only last so long as that boom does?
That is a fabulous question, because as soon as you saw all the banks report their earnings, one of the first reactions you got from a lot of analysts and investors was they were paying attention to the compensation costs, even though the banks were eager to say that this is not a new floor. We're paying for performance. If performance goes down, we will cut back pay. But the question is, pay tends to be sticky. How easily can you take someone from 5 million to 10 million one year and then bring them back to 5?
Sri, I wonder about the kids. I believe that our children are the future. And when they graduate now, what do these banks tell them to try and get them, as Kaylee was saying, away from the lure of San Francisco and like ping pong tables and nap pods? You know, is it pay, or can they also offer them a real work-life balance?
From all the stories we've seen over the course of the last year, work-life balance is not the thing that Wall Street leaders are preaching. But they are saying that if you're willing to work hard, if you're willing to accept the first 2 years of really hard work and a lot of toil, you are still going to get unfathomable riches. If you're graduating from college when you're 21 years old and you're promised a career where right out the gate you're getting $150,000, $200,000, that is still pretty damn attractive.
Yeah.
Even if you have to work 100 hours a week to get it. Thank you so much to Sri Nadarajan, one of our senior reporters here at Bloomberg. Now, other than how much they're making on Wall Street, here's a look at what else we're watching today. I am watching the ADP data dropping at 8:15 Eastern. We are expecting about a print of 184,000, but of course we had a massive upside surprise on ADP last month and then a downside surprise on payroll. So there is a question of how much of an indicator this is as to how Friday's jobs report will go, but nonetheless, something to watch, Matt.
Yeah, I'm also watching Meta earnings. The company formerly known as Facebook comes out after Google beat expectations on both sales and profit, and Google also had a pretty decent outlook. The question is, does Meta get the same kind of ad revenue that Google has gotten? And for the future, for the outlook, I'm wondering, can they really take a huge slice of the pie of the metaverse just because they're named that, or will they lose out to other big competitors in the space? Anna?
Yeah, and I wonder what the ad sales numbers that we got through yesterday from Big Tech, what they tell us about what Meta will say. I'm focused on the EU and its green policy. Sounds a bit dry, but could have real implications for asset allocation. How will the EU decide to label investments of gas and nuclear? This is something that has divided member states, and we're set to get some form of resolution today. We will talk to a European Commissioner, Mairead McGuinness, on this later. This is Bloomberg.
Has announced it's moving 8,500 more troops to Eastern Europe. If they're not being deployed to Ukraine specifically, Why is that so important, and does that risk further provoking Russia?
Well, there's two things going on. So what the United States recently announced is that we are going to put 8,500 troops that are part of the NATO response force on high alert. That means they'll be ready to deploy on a moment's notice should we need those forces anywhere in Europe to protect NATO territory. In addition, the United States is also looking at possible additional moves that they might make to move U.S. force posture into Central and Eastern Europe. The reason we're looking at that is because a lot of the members in that neighborhood in Central and Eastern Europe feel concerned. And so we are looking at what measures we might take in the name of reassurance and deterrence.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
As a company grows, there are more challenges. What do you worry about the most?
The market opportunity for us is enormous, and so our challenge is to continue innovating, driving, and pushing ourselves every single day to go after the most attractive profit pools in this incredible global beauty and wellness market.
This is dancing on the head of a pin for the Fed.
This is not a Fed that's committing to forward guidance.
They're attempting to engineer a soft landing.
Fortunately, the risk of recession is exceedingly low.
The big fear is the Fed's going to be more aggressive.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Alphabet knocking it out of the park from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market's up nicely this morning. TK, those numbers out of Google, pretty tidy.
Yeah, better than nicely. John, I'm not going to go with nicely with the NASDAQ up 1.5% right now, with the Dow lift, with the VIX back under 22. This is a sea change moment. We saw it with Microsoft. We saw it with Apple, and Google just said, once and for all, this is different. These companies are different. They've got a playbook that's based on cash flow and profit.
Before we get into the stock split, let's just park that for a moment.
Yes.
33% ad revenue at Google, Tom. That's the pop.
Yeah.
These are real numbers in a massive business.
And what's important here, John, and I go to Itay Macaulay at General Motors with a long-term price target from $54 up to above $200 at GM. And what I'll say, John, is what's common here is a new confidence that successful companies can get beyond the pandemic and generate again profit and cash flow.
These stock up in the pre-market by almost 11%. Lisa, should we get into it? A 20-to-1 stock split. An Alphabet.
Basically saying that they're trying to make their shares more accessible to mom and pop investors, that basically they'll be able to buy in size. Of course, you can buy fractional shares. It's sort of an argument that has been discussed for a long time, but they also had a very small dividend, a one-time dividend that they put with this. I really feel like we have to blow up the show, though, John.
Go on.
And it's all about just getting included in the Dow Jones.
Are you just trying to wind me up and get TK going?
It's literally the truth. Basically, a lot of people are speculating that that's the reason why, because they want to cater.
Are you taking my role today?
To Tom Keene, to include them.
TK, you and I have been going back and forth on this for much of the last decade. I remember our first big argument about it was back in 2014 when Apple did this. Tom, I hate the way it's covered. I hate the word cheap.
I hate the way it's covered.
I hate the word cheap. I don't think it makes a difference. To Lisa's point, fractional share ownership is a thing. I think it's one big PR event, which is exactly what the Dow is too.
And the answer's the why. I'm out front on this, and I'm going to be blunt. When C. Gasparino over at Fox has been out front of it too. This all has to do, John, with appeasing Washington. They're hypersensitive about regulation, and they got people like the Quality Act, Ruth Porat, saying to them, get off your Silicon Valley high horse, do a stock split, get more accessible to the public. And John, there's nothing that says accessible like being in the Dow where Microsoft is 5.7% of the Dow, and Intel is 1% of the Dow.
Does it actually make it more accessible, or does it just make people think that it's more accessible and think that they should probably go and buy it now? It drives me
Lisa, he's
insane.
so damn
I will say this, though. I'll say this. Lisa, Tom's been on about this for a while. Yeah. Look at Amazon now.
Yes.
Because Tom and I have been having a fight about this for, as I say, much of the last 10 years. And he's been saying Amazon needs to go, they need to go. And I don't know, maybe they will.
Honestly, the fact that the shares are up as much as they are, yes, they had a blockbuster earnings season, but this also is partly being attributed to the stock split where other people seem to be buying into this idea. So why wouldn't Amazon do it? I mean, what's holding them back, given the fact that their shares are in the thousands of dollars per each one?
We'll spend some time on this, I promise. But we have other things to cover too. Futures have got a really nice lift off the back of this story with Alphabet. The earnings from big tech have been tremendous. Dan Ives of Wedbush has written into the team. My producer Jamie shot this one over. The tech bears now go back into hibernation mode with this jaw-dropper Alphabet quarter, TK.
John, you mentioned Dan Ives. I'm going to interrupt here. He has been dead on about what Itay McCawley's talking about of Generous Motors. Dan Ives is saying GM is a tech company, and Itay McCawley, car guy today, agrees with Dan Ives with a shocking forecast for GM out years.
Looking forward to catching up with Mary Barrett a little bit later this morning. We'll do that 9:15 Eastern time. Into the bond market, Lisa, yields unchanged on 10s, 179.65. The euro, Lisa, an inflation pop in Europe on the headline number in the fives.
Yeah, more than 5% on an annualized basis, and it was a surprise. The median estimate was for 4.4%, and no one expected an acceleration like this in the Euro region. A lot of it had to do with energy prices, and this is what I want to sit on. Today we get that OPEC Plus meeting that we're going to be discussing the potential increase in oil output. Whether they can actually deliver that, of course, is the question at a time when oil prices are at the highest levels or around there, going back to 2014. How do we factor this into inflation? I mean, honestly, John, when we take a look at inflation expectations, if oil remains this high for this long, at what point does it become ingrained in consumer psychology? And a lot of people are trying to parse through the data from the 1970s to truly understand that. 8:15 a.m., we get ADP private payrolls. No one cares. The headline number doesn't matter. We've all learned that from Fed officials, from Washington, D.C., when we look at the jobs report on Friday. However, wages, that is what I'm going to be focused on. How much are average hourly wages going up year over year? Can we get a sense of any surprise momentum there that could shock the Fed in some kind of way, maybe a 50 basis point rate hike, which I also am trying to tweak you with, John. And aftermarket, we get Facebook. Don't worry, I am not going to call it Meta, reporting after the bell. The expectation here is that they are going to repeat what we just saw from Alphabet or Google, because I'm not going to call it Alphabet, Tom. The issue here, though, is how much is ad spending really going to continue to drive this? I mean, we're talking about content being king. Really, John? We saw Netflix, but now it really is the advertisers coming back in force, even without those services coming back online in full.
I let the side down, didn't I? I called it Alphabet and not Google. I'll keep referring to it as Google. Lisa, thank you. Who would like a sneak peek of the inflation estimates for next week? CPI in America, Tom Keene, Barclays at 7.3%, Morgan Stanley at 7.3%. These estimates just started to come in. The number comes out a week tomorrow, but north of 7, Tom.
Yeah, it's there, and it's rental, and it's oil, and, you know, I guess we're back to $90 a barrel, 89.26. And, John, it's also what we saw in Europe. Higher numbers in Europe this morning get my attention.
The ECB gets my attention tomorrow, too. Eric Robertson joins us now, Global Head of Research at Standard Chartered. Let's start here, Eric. You've got a call for 4 hikes this year. It's not just your typical 4-hike call. You're looking for it to be front-loaded, meeting after meeting into summer. Eric, why is that?
Hi, good morning, guys. Look, there's a couple of factors that we think are interesting. Number one, according to Jay Powell at his press conference last week, there's a real commitment now to shifting into a monetary tightening regime. And if you read between the lines, it does look like the Fed feels like perhaps they've waited a little bit too long, keeping rates at zero. So I think that's one issue. Number two, as you guys have been discussing, the inflation statistics continue to look extremely elevated. We expect that to be the case for most of the first quarter. So we think the Fed wants to sort of get out in control of the narrative. And doing 4 hikes before the midterm elections in November, we think could be a big priority for them.
Eric, do you think that the market's accurately priced in this front loading?
I do, because if you look at the way the rates curve has behaved over the last couple of months, every time the Fed gets more hawkish, every time the data is stronger, what you see is the market pricing in rate hikes in 2022 and 2023. And yet, if you look at the spread between 23 and 2024, it's completely flat, right? So the market is effectively saying the Fed is going to have to do all its hard work over the next 18 months before the business cycle starts to roll over.
So I'm trying to understand how much to look at the earnings, because it seemed like yesterday the story was, oh my goodness, the Fed is going to hike rates more than people expect, and markets are not recognizing it. Today the story is earnings are so great, people haven't listened to how great the earnings are, and the Fed has been priced in. Which is the correct narrative?
Well, one thing that's a little interesting, and we're still trying to get our arms around this, is that there seems to be a slightly different narrative coming out of the Fed this week. I mean, there's no disputing that Powell was very hawkish last week, but the Fed's speeches over the last couple of days have leaned more in the direction of we're comfortable with 4 hikes, but we don't necessarily want to do anything that jars the markets or the economy. And I think that's given both equity markets and fixed income markets a little bit of relief. In terms of earnings, you guys have made a great point earlier in the show, which is that the high quality names, the mega cap tech companies, for example, have produced stunning results. And that's obviously giving some comfort back into that portion of the equity market.
Eric, you've got a great bond market call. Curve inversion, maybe, before the end of the year. Eric, is that going to dissuade the Fed from pushing on? Or is the fact that the Fed doesn't care that means we end up with a inverted yield curve?
Well, if you hit the nail on the head, I mean, look, if you listen to Jay Powell and you take him literally, he said yield curve signals are not ironclad. Frankly, I'm less interested in what the Fed says about it now. Our view has been for a long time that the yield curve would continue to flatten, that we would approach a very flat yield curve by the middle of the year with a significant risk of inversion. We all know that regardless of what the Fed says, if that happens, the market will start to question the continued rate hiking cycle. The market will ask serious questions about the sustainability of growth. And I think that's a big story in sort of Q2 and Q3, and something that we've been arguing for since late last year.
Eric, I've really enjoyed the research over the last week, particularly from you and Steve Englander. Keep it coming. Eric Robertson there of Standard Chartered. Can we finish this segment on some good news? Just on the COVID front, the numbers are so much better.
Yes.
The numbers in New York were 90,000 just a few weeks ago. There were 7,119 new positive cases on Monday. The positivity rate in New York, Tom, is down to 5.92%. It was 23% on January 2nd. It's a massive turnaround, TK.
Massive turnaround is predicted by our guests, our professionals that we speak to, John. It's hugely regional. The Northeast leads the way because of vaccination. Ben Mueller and Eleanor Lutz in the New York Times today have a fantastic article, John. It is a disgrace with the way America is versus other rich countries. It's just, even Britain, John, it's stunning, the gap between us, and it's all regional. That's the reality, and as you say, the Northeast does great.
When it comes to the economic data, though, that means we can ignore the numbers on Friday. For a lot of people, that's the view, Tom.
John, I'm sorry. We need to inform. Let's look at the Dow makeup right now, folks.
That's what you want to do right now.
In July or August, and we've got to look at Microsoft. I mean, I'm sorry. Microsoft is there with a big number, and Intel is a bad number.
This is why you didn't take part in the interview with Eric, isn't it? You've just been doing that for the last 10 minutes.
I've been doing Dow work.
I can tell. Futures are up on the S&P. What's the Dow doing there? The Nasdaq 100 up by 1.3% from New York City. This is Bloomberg.
With the first word news, I'm Ritika Gupta. Russia's President Vladimir Putin is repeating his claim that it's the US and NATO causing tensions over Ukraine. At the same time, Putin suggests that further talks could help resolve the crisis. US and European officials say they are open to diplomacy, but they won't agree to a key Russian demand that Ukraine be barred from joining NATO. The Biden administration is lowering expectations for this week's jobs report. The White House says that brief absences of workers due to Omicron could overstate the number of unemployed people for last month. Surveys for the January payroll numbers were said to have been taken as coronavirus cases soared. And OPEC and its allies are expected to approve another modest oil output increase today. At the same time, they'll have to struggle to deliver. In November, the group only implemented about 60% of its increase. Members from Nigeria to Russia have been running out of spare capacity, and it's difficult for them to revive output after years of cuts and underinvestment. Alphabet is bringing big stock splits back to the market. The Google parent announced a 20-to-1 split, dropping the share price to about $140 from almost $3,000. The split could help Google gain entry to the Dow Industrial Average. And Spider-Man has come to the aid of Sony. The Japanese Electronics and Entertainment Corporation, Sony, reported strong third-quarter earnings and raised its fiscal year forecast. The credit goes to a new blockbuster Spider-Man movie and sales of image sensors used by Apple iPhones. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become Chief Future Officer. This week, find out how CFO Luca Zaramella is using local knowledge to help Mondelez grow its global portfolio.
I know our people, I know our customers. We tend to believe that all consumers are equal. They are not.
Chief Future Officer, brought to you by Workday, Wednesday on Bloomberg.
The Omicron variant and the latest wave have an impact on not only consumer trends, but your business. And do you expect the booster shots to make a difference?
Yeah, booster shot will make a huge difference. I think it's been accelerated by the huge leadership of the current Prime Minister Kishida. And I'm hopeful that our business will come back in Japan around perhaps mid-February to end of February, because we expect that a peak time will come around that time. And then the government will shift toward the reinvigoration of consumer. That will help us. And we had seen the huge comeback of the business in December when the things were toward the normalization. So I believe the business will come back, and I'm very much hopeful.
season continues.
Not since the 1980s have we seen these sorts of reversals.
Bloomberg is fastest with the numbers and analysis.
The fundamental story is really solid.
It's really kind of a balancing act.
Bloomberg, the fastest numbers and analysis you trust.
Alongside other countries, we are also preparing a package of sanctions and other measures to be enacted the moment the first Russian tow cap crosses further into Ukrainian territory.
Boris Johnson there, the UK Prime Minister, on the tensions between Russia, Ukraine and the rest of the world. From New York City with Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. This equity market's got a real lift to it, up 0.7% on the S&P. On the Nasdaq 100, up another 1.3%. Coming into today, a three-day winning streak, 3 days, a 7% plus gain on the Nasdaq. It's a bounce back. Into the bond market, unchanged at 179.12. Euro dollar back with a 113 handle. Euro dollar positive, 0.33%. That's the stronger euro, Tom, going into the ECB tomorrow off the back of a higher than expected inflation print on the headline number.
John, what are we going to see in the ECB tomorrow? Is it a snooze fest?
Is it a test of the ECB strategy for this year, Tom? Can they really sit out the whole of 22 without an interest rate hike, given the trajectory of things? Will they take comfort from what's happened on core inflation? That's okay. Headline inflation, higher energy prices really kicking in there, Tom. Will that persist through the rest of this year?
Very quickly, HSBC with a smart note out of Germany today, John, saying the Bund terminal value continues to signal negative interest rates.
And they've got a softer economy too, Tom. Those GDP numbers out of Germany have not been great.
Yeah, absolutely. Right now in Washington, Anne-Marie Horton joins us, Bloomberg Washington and Wordle correspondent. Anne-Marie, has Wordle changed since the New York Times took it out?
No, thankfully.
No. Okay, it's good to know. Right now, we got the president coming up to New York to see the mayor. They're going to talk domestic issues, but he seems to be completely taken by Ukraine. Give us the not the percentage, but just give us the amount of energy that they're putting into the study of Ukraine.
Well, the president will be in New York tomorrow. That's correct, Tom, and I'll be there with him. When it comes to the crisis right now regarding Russia, Ukraine, you can see just the movement we've seen from the administration across the different institutions. You have the White House, you have NSC, you have the State Department, you have Democratic and Republican senators. You can see how everyone in Washington has had to shift focus, what they plan to focus 2022 on this crisis right now taking place in Europe. You have the NSC head when it comes to cyber going off to Europe. You have individuals in the administration now having to focus on this issue when their time would have been spent on a number of other things, especially a pivot to the Indo-Pacific.
I mean, Mike Gallon just publishes at Axios his morning note. He says, closer to war. Are we, Anne-Marie?
Listen, we heard from President Vladimir Putin yesterday, and I really wanted to see what his tone was and his rhetoric when he was standing alongside Viktor Orban, a NATO member. We should remember Hungary is a NATO member. But his tone was quite modest, and there wasn't a ton of rhetoric against Ukraine itself. And this is what the TV data is showing on these state-controlled Russian television and websites and their press. Actually, the rhetoric from President Vladimir Putin was against NATO and the United States. And he left open this possibility of diplomacy. And that's what we're hearing from Dmitry Peskov, the Kremlin spokesman, this morning, that Putin is optimistic on potential security dialogue with the United States. So there's not saying that he's not going to invade Ukraine. You cannot write that off when you have 130,000 troops on the Ukraine border, which the United States has that tally at, as well as Russian troops in Belarus, which if you look at a map, Belarus on their lowest point of their border is about 2.5, 3 hour drive to Kiev. You cannot write it off yet. But Putin did leave open this door for diplomacy. And his main attack yesterday was that the United States, quote, ignored their security proposals.
Anne-Marie, we've been talking about the Ukraine-Russian issue amid this Washington whack-a-mole where they're trying to deal with a million different issues and shift the focus back to the domestic policy. What's Biden doing when he comes to New York?
When it comes to New York, he's going to stand alongside the mayor, Eric Adams, and he's going to talk about, he's going to want to talk about tough on crime, especially this is something that the Republicans have really tried to take a hold of ahead of the midterms, that the Democrats are just not in place to be able to address what we're seeing in potentially higher crime in cities. And he's also going to, of course, talk about the fact that he stands alongside police officers, and he'll be with, of course, Eric Adams, who himself was head of that force at the NYPD.
Anne Marie, we've seen a number of stories talking about how certain public service jobs, police officers, teachers, healthcare workers have been dropping out of the profession at record paces, in part because they've had to be out there during the pandemic. They've had to actually be exposed, as well as pay that's lagging behind other sectors. How much is this becoming a conversation that's significant in Washington?
Well, for the Biden administration, they've been very much focused on the fact that they want to push forward and a discussion on wage gains, right? And also the fact that we should be giving individuals, like you mentioned, police officers, teachers, people who have been working throughout the entire pandemic, people that they want to get back into schools and back on the street, but some of them, especially women, the administration will say is still dealing with childcare issues. They will push forward on how there are different measures or pieces of their Build Back Better legislation, which we should note yesterday, Senator Joe Manchin did say, I don't know why you're asking me about it again, I told you it was dead, but they will point to in pieces of legislation or chunks of it within that broader economic agenda they're trying to push forward who can actually help these individuals.
Let's put a bow on this, AMH. When you hear the Republicans speak right now, they want to have three conversations: inflation, crime, education. Inflation, crime, education. Any one of the three, maybe all three put together. Does the situation in Ukraine even register domestically for voters at the moment?
Well, when you look at the polls, and most recently the polls would show things like foreign policy and Afghanistan, it just doesn't. You saw President Biden's polls take a hit when the withdrawal happened with Afghanistan, but do you hear Afghanistan being spoken about on mainstream media ever? These are issues that Americans will hear about, and a lot of the time the press will focus on, but it's not top of the polls. When you look at the Michigan Consumer Sentiment Index, and Jonathan, you and I have spoken about that, 75% have viewed inflation as a crippling economic issue, and there wasn't much of a difference when you polled Democrats and Republicans.
That's the big issue on the horizon going into the midterms. Anne-Marie, thank you.
And tomorrow.
Down in DC. And of course, tomorrow too. Anne-Marie, thank you. Elisa, crime, education, inflation, three of the big issues right now in America.
Yeah, especially coming out of the pandemic, we saw crime rates tick up, still very much below where they had been maybe a decade ago, but still very much a concern, especially for the biggest cities that are trying to bring people back. Education. Now, this is an area that's incredibly difficult, especially as teachers quit, and especially with some of the new restrictive rules around race teaching and critical race theory. I mean, there's so many hot button issues that are going to be really hard for the Democrats to message, but are really the key issues driving voters right now.
That's the US. Just to sit on Europe, just for one further beat, Tom, starting to bring forward rate hike bets for the ECB 10 basis points into the summer. Klaus Vistesen of Pantheon Macro saying this inflation number is a bit too hot to handle. The ECB coming up tomorrow.
It's political. It'll be interesting to see what Lagarde does as she nudges and I guess tilts towards a dialogue with Germany on this.
Tom Keene, Lisa Bravitz and Jonathan Ferro. Futures positive here at 1.4% on the NASDAQ, on the S&P up 0.7%. On radio, on TV for our audience worldwide. This is Bloomberg.
this chip shortage is going to last longer than many people believe, likely straight through this year. And I wonder what that means for prices. Will this get worse before it gets better?
I don't know that it will get worse before it gets better, but there's no reason to believe it's going to get meaningfully better anytime soon. The Commerce Department put that data out yesterday, and what it showed is that there's a real shortage. Demand is 20% higher than it was a couple of years ago. There's a huge mismatch in supply and demand. Prices are high. Prices are higher. So what has to happen is we need to make more chips. Unfortunately, there's no easy solution. The solution is increased domestic manufacturing of chips, which is what we need to do.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Equity futures doing nicely here on the NASDAQ. 3 days of gains into Wednesday. Looks like it could be 4. The NASDAQ 100 up another 1.4%. We get a lift here on the S&P too, up 0.7%. Comes down to one name at the moment. It's Alphabet. Let's take a look at the pre-market. This name is a $1.8 trillion company. It's up 10% in the pre-market. Just think about that. A $1.8 trillion company up 10% in the pre-market. We can talk about the stock split a little bit later. Tom, let's talk about the numbers. Revenue growth in the ad business for Google up 33%. That's real growth for a monster company. That's what's leading this stock higher, much higher.
And the idea here, John, is what is the terminal revenue growth value? And for all of these different companies, no one's talking 5, 6, 7, 8%. They're not 32%, but they got a run rate of 15%, 18%, whatever. This is a 3-year view move on Google, on Microsoft, and on Apple.
It's a big move. Dan Ives of Wedbush saying the tech bears can go back into hibernation. Maybe they are for now. Can you do the same if you're at a central bank and you're a dove? Maybe you're already hibernating. Switch up the board and get to the bond market. Let's look at the US. Let's look at Germany. The 2-year yield in the US, just below where we've been, dancing around, 120 at the moment, 117.15. We can talk about that into Friday when we get payrolls. Let's talk about the ECB tomorrow. Front end of the German curve, inside the depot rate, so we're trading at negative 46 basis points right now. Interest rates of the ECB, negative 50. German 10-year into positive territory, 4 basis points into positive territory now. Curve at the front end, Tom, just a little bit higher as we start to push higher there and think about, I didn't think we'd be thinking about this, but we are. We're having a conversation now about interest rate hikes at the ECB. Not the 4 or 5 that we will at the Fed, perhaps, but maybe something at the end of the year, maybe something perhaps even in the summer, Tom. That's a conversation I didn't expect 18 months ago, but here we are as inflation on the headline number surprises to the upside and goes deeper into the 5s.
Yeah, the phrase there is hits records. Well, let's move into this right now. It's 6:31 Wall Street time. You're focused on America, on Bloomberg Radio, on Bloomberg Television, but Europe matters. We speak with Gilles Moek, Chief Economist, AXA Investments. Of course, their huge operation in Paris. We're thrilled that Gilles could join us this morning. Gilles, I want to get right to this. 5% inflation is a general statement. The phrase hits record. How does a Bundesbank, how does a Germanic culture react to that and adjust the tone at the ECB?
They're not going to like that. It's definitely a big number that we've got. Not just because headline inflation is strong. Core inflation was expected to fall below 2. It's above 2, and as you know, in Europe, being above 2 is a bit of an issue. But even beyond the Bundesbank, I think many people at the ECB board are going to look at those numbers and think, hey, we need to really think hard about normalizing our policy. I was expecting them to hike anyway in 2023. I still believe that they will hike in 2023. I think they should resist pressure to do so in 2022, but the direction of travel is pretty clear, and quite different from the debate just 3-4 months ago. 3 or 4 months ago, the big question was whether or not they would hike in 2024. Then we're moving into 2023. There's the beginning of conversation about 2022. It would be complicated for them to move in 2022 because the forward guidance says we're going to continue QE until October at least, and we are not going to hike before the end of QE. So at a stretch, you could do it in December, but it would really be a stretch. Of course, central banks can always move away from their forward guidance, but it's costly.
John wants to get in here with his real expertise on this, but one more question, Gilles, and it's real simple. How does Christine Lagarde deal with the heritage and legacy of Otmar